We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
Gasoline prices are high because it's mixed with ethanol that went tenfold. Gasoline prices are high because there is low stocks in the U.S.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising. This market is just flying. From New York City this Friday morning, good morning. 6-day winning streak on the S&P, call it 9 on the NASDAQ. We're up again on the S&P 500, up 0.5%, up 25. The small caps like what they see in the data this week. The small caps up more than 1 percentage point. The NASDAQ up 78, advancing 0.5%. That's your opening bow. Switch on the board and get to the bond market. In the bond market on 10s, yields in 4 basis points, 148.79. Some calm out there. A break of 50 again, 150. In the FX market, euro dollar down negative to 115.31. That currency pair negative 0.2%, and a lift in crude back through $80.05, up by 1.56%. In this market, we've got to talk about more all-time highs, and that winning streak continues to 7. The S&P 500 up 0.5%. Top of the pile, industrials up 1 percentage point. Energy up about 1.02%. Bottom of the pile, healthcare down by 0.75%. With me to break this down, I'm pleased to say, PGIM's Mike Collins and Anastasia Amoroso of iCapital. Anastasia, let's get straight to you. This equity market is flying. Do you like what you see?
I do like what I see, but at the same time, some of the moves that we've seen in the markets have been parabolic. And for example, in the very beginning of Q4, we've been flagging that Q4 is going to be typically ends up being seasonally strong. 78% of the time it's higher, and on average it's higher by 4.5%. Well, we are already just a month into the fourth quarter, and we're up about 8.5%. And we still have almost 2 months to go till year end. So I think it's been a very impressive rally, but it's happened very quickly in the month of October. So near term, John, I have to say that this does give me a little bit of pause. I think we are due for some sort of a breather in some of the sectors that have done exceptionally well, which I still like fundamentally, like semiconductors and energy and real estate, but they've just been top performers, and I think they're a little bit susceptible here.
Absolutely flying. The stock market over the last 7 days now higher by 3.3%. Mike Collins, I quoted you earlier. This was the quote. Overall, markets seem to have drawn a pro-growth conclusion from the press conference with Chairman Powell, perhaps to some degree stemming from the chair's comments that rate hikes would only be considered after full employment had been achieved. Mike, the data this morning, pair that with the commentary from the chairman and why this equity market keeps flying through all-time highs.
You know, Jonathan, and the jobs number and the chairman's comments aren't the half of it. I think this news actually from Pfizer and on the COVID side are a game changer, right? I mean, this is a real positive for the supply side of the economy and the demand side, right? I mean, we've been talking about, real rates are probably fairly valued at negative 1%, but it's the inflation expectations that were elevated, right? And now they're starting to come down, and you see this drop in long-term interest rates today, which isn't a surprise to us, right? Because the opening up of the supply side with the job market continuing to heal and the COVID thing really reaching an end, I think, is a super positive for the markets, and risk assets are on fire today, including the credit markets.
Well, let's talk about that single name. Pfizer up by 8% in early trading. Our reporter Robert Langreth talking about this, reporting on it for us. Pfizer saying that its COVID-19 pill reduced hospitalizations and deaths in high-risk patients by 89%. Anastasia, you might not want to comment directly on the name, but on the broader story, there was a hope this time last year we could reopen and get back to whatever normal is. Do you share that hope for next year?
I think we all share that hope for next year, but it does seem like it is a lot more realistic for next year. So not only do we have vaccines for the adult population, we have the vaccines that are now approved for the 5 years old and plus population. So that's really key. And then the fact, to Mike's point, that you can keep people out of hospital if they're not vaccinated by virtue of this new treatment, that's really, really important. And when we look at the recovery trade, the reopening trade, as you know, a lot of progress has been made on the recovery recovery in domestic travel, for example, but there's still a ways to go when it comes to international travel and it comes to business travel. But what I'll tell you, I'm seeing anecdotally on the ground, a lot of businesses are getting back to work. They're getting back to events. And I think all of this news around the vaccines and around the medicines, that's only going to strengthen that momentum.
I saw a lot of analyst action around the name Peloton. We talked about Truist earlier this morning, about 10 minutes ago, downgrading Peloton to a hold after earnings, citing a lack of near-term catalysts and slowing demand. I mean, that really is understating it. 3 months ago, they were looking for $1 billion more as a year-end guide. That's the cut, $1 billion. The stock is down by 33%. And Mike, that single name captures a broader story for me. This economy, single names, this story is moving so quickly from month to month. I find it difficult to see how companies can actually give us real clarity for next year, and economists too, market participants. The range of outcomes still, from my perspective, Mike, and you may well disagree, still seems to be really wide. What's your take on that?
Yeah, the single name story is really what's happening here, right? As we shift, Jonathan, from this demand for goods, which has been going on for a year and a half now, back to services finally, right? This is something we've been expecting for a long time, and we've been wrong, frankly, but it's happening now. And again, with this positive news on COVID, I think it's going to accelerate over the next 6 or 12 months. I'm taking my first real business trip to a conference in a week from now, right? Flying across the country. So it is happening, to Anastasia's point. But the dispersion among companies as we go through this big transition, right? And it's not just the transition from goods to services. We're going from easy policies to tighter policies. I mean, a lot of things happening, and you're going to see dispersion, which has been really tight in the credit markets. You're not seeing a lot of difference in spread or pricing between risky and safe credits. We think that dispersion is going to increase here, and there's an opportunity to generate alpha for active managers.
Anastasia, does that resonate with you?
Yeah, it certainly does. I do think there's a lot to do in the equity markets and the ability to be discerning with the sectors. I wanted to pick up on the inflation expectation story and how those have been coming down. I think one of the big stories which will differentiate itself in the equity markets next year is going to be about restocking and rebuilding those inventories. And by the way, the supply chain issues seem to be clearing up. So one thing I wanted to pick up on from the payrolls report this morning, we saw an 8% increase in wages for transportation and warehousing industry. So we're now paying out for those workers, and those workers are coming back. So I think as we go into next year, we have a chance to de-bottleneck some of the log jams that have been created. And so that does give more competitive advantage to some of those industries. But again, we're still going to be looking at pretty significant, pretty high inflation next year. So I want to stick with sectors that can pass through some of those higher costs and have the demand that's still solid. So that's why today, I probably wouldn't buy semiconductors right here. I probably wouldn't buy energy right here, and maybe I would shy away a little bit from real estate. But if we get some sort of a pullback, some sort of a catalyst, those are the three top sectors that I would be looking to buy on the pullback.
Well, let's bring up tech as well. Tech up for a 10th straight day on the NASDAQ 100. What a run it's been. All-time highs again with the story. Here's Abby.
John, an incredible story. That NASDAQ 100, as you just mentioned, up 10 days in a row. The best winning streak, longest winning streak of the year, gaining 7% over that time period, matching a streak last December. And similar to last December, this isn't about the pandemic stay-at-home safety trade of tech, but tech for tech growth. Take a look at that, up 7.1%. And not surprisingly, it has everything to do with yields coming in. Over the last 2 weeks, we have seen a dramatic drop in yields from the 5-year, 7-year, 10-year, 30-year. Look at that 30-year coming in 16 basis points. When yields go up, valuation comes into concern, as you know. But put another way, when yields come in, the present value off of discount rates, assets go up. So that really makes tech look more attractive with yields coming in. Not surprisingly, we now have the correlation between U.S. stocks and bonds going negative. That's been the case for much of the last 2 years, John, as markets have simply gone higher. There have been bumpy patches last September and October where the correlation was higher because as yields for bonds went up, we had stocks go down. But it does seem, John, that we're in a smooth period here where perhaps we're just going to see these yields supporting growth going higher.
Abby, thank you. Let's build on this. The relationship between real yields, bond yields, and what happens with the tech sector in the equity market. Chris Harvey of Wells Fargo weighing in.
What we've seen this year, real rates go down, tech, high growth outperforms. Real rates go up, you see the opposite. The Fed is the 8,000-pound gorilla. right? When they start stepping out, you should start seeing real rates start to drift higher. They go from the 8,000-pound gorilla to the 800-pound gorilla. If they're not buying or they're not hoovering up all the bonds they possibly can, it should go higher, albeit at a rather slow pace. And that should be good for your cyclical trade.
We have got the perfect two guests to discuss this with. On the rate side, we can do that with Mike Collins. On the equity market, target together, Anastasia Amoroso. Anastasia, just run us through your thinking on that relationship between real yields and tech in the equity market.
John, I think that relationship definitely holds near term. We've seen this over the past year or so. When rates rise, you have a little bit of a pullback in tech stocks, and then the dip buyers step right in. So I think it's a short-term relationship, but at the end of the day, what really prevails is growth, and tech is where the growth is. What's interesting is if you look at the instances of rates moving higher and rate increases, rate hiking cycles over a period of time, you see that S&P still delivers positive returns, but even more interestingly, the Russell Growth Index still tends to be positive, and significantly so, even during the rate hiking cycle. So maybe it's a short-term relationship, but longer term, what the markets care about is, can these companies deliver growth? So to me, you still stick with tech, you stick with growth. But if I'm being very tactical, if I look at the setup right now, you look at software, you look at some of the valuations there, they're literally off the charts. And that's where investors are very long. So if, for example, we get to the December FOMC and it is more hawkish than we're positioned for right now, and if we get those dots that are indicating a 2022 rise, you could have a near-term hiccup in rates moving higher and tech moving lower. But once again, that's what investors would look to buy.
Mike Collins, how are your thoughts evolving on the real rates part of this story?
Yeah, you know our view, John, a negative 1% real rate is where it's supposed to be. That is actually fair value. Investors who are flush with cash are not supposed to earn a positive return over inflation by sitting in cash and treasury bills, right? They're supposed to pay to store their money. That's the world we live in. So that is a normal relationship, and that is good for valuations, right? It continues to support higher than historical equity valuations and probably tighter than historical credit spreads, right? We've always had the view lower rates actually force people into more credit, into more corporate bonds, high yield bonds, et cetera, which lowers those relative yields or spreads on the credit sectors. And you're seeing that today, right? You're seeing the rates come down, real rates fall, credit spreads tighten. That actually feels like a pretty normal relationship in the near term, right? Over the long term, we can talk about credit risks on the horizon.
Well, we can talk about that a bit more, but just a final word, Mike, on what you just said. You are undeserving of a real return on sovereign debt, on the risk-free asset. Is that essentially the argument you're making? And is that shift a permanent one, Mike, as far as you're concerned?
Absolutely, Jonathan. Everybody in the world's getting older. Savings rates are going up and have to go up in places like the U.S. There's a supply of savings, excess glut of savings, and not enough investable assets out there. You see Treasury supply is coming down, not going up, right? So just like you store your stuff in a storage unit, you pay for that. You have to pay to store your money. I think that is normal, and that's going to be the world we live in for a long time.
The new normal. Mike Collins of PGIM sticking with us alongside iCapital's Anastasia Amoroso. Your equity market, all-time highs. Your commodity market, just a little bit firmer, up 1% on WTI, just short of 80 at 79.61. Coming up, OPEC rejecting the president's plea for more barrels.
We have a record to show comparing us as OPEC Plus, not as what some of you unfortunately call us as a cartel, but as a responsive regulator to a market that needs to be regulated.
This one's getting a little bit more contentious at home for the President of the United States. That conversation is next. This is Bloomberg.
подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Тоже это не пробуем, в чем дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. То есть второй будет проще.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now.
Wrap it
into
up.
Weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
I say that we can basically do more for ourselves. We've been energy independent for the first time in 67 years. Why can't we do more? Why can't we produce more? We've got plenty of natural gas. My state, beautiful state of West Virginia, has an ocean of natural gas under it. If they just let us build a pipeline, we could get the product to market. And why don't we do more drilling? And why don't we do more, basically, production in the United States? I'm not depending on OPEC. I'm not depending on other countries for my energy anymore. We know how to do it. We have the technology. We should be relying on ourselves.
Senator Manchin saying we can do more at home to tackle the energy issues in America. Secretary Granholm had a different reaction.
Oh my God, that is hilarious. Would that I had the magic wand on this. We are reliant on a global gas market. I mean, the global gas market, we can't just produce oil for the United States. It is on a global market.
Down in D.C. from Washington, back with us, AMH. Morning, Anne-Marie.
Good morning, John. Energy story is really heating up here in Washington. Two things really to take note of. First, OPEC Plus, led by the leader, Saudi Arabia, which is an ally of the United States, have pushed back, and they're only going to modestly increase production, the 400,000 barrels a day, not what the U.S. was looking for. And this comes off of the president's European trip in Rome and Glasgow, where he said constantly that it was up to OPEC Plus and it was their fault that they need to produce more. On the second hand, when you spoke to Secretary Granholm, she said at $80 a barrel, why are oil companies in America not incentivized to do more? Well, the president's first day in office, Jonathan, he killed the Keystone Pipeline. He also imposed limits on federal drilling. Now, experts will say that potentially didn't move the needle too much. But the fact of the matter is that the fossil fuel company, oil and gas companies, do feel like the rhetoric from the White House is creating a little bit more of a hostile environment. At the same time, you had a price crash in 2020. And shareholders want returns. That's what they want. And Scott Sheffield from Pioneer basically said that yesterday, saying that the shareholders want returns now. And if the President of the United States wants to see more production, he's going to have to influence those investors that now is the time to wanting to put money back into this industry.
For people who missed that interview with the Pioneer CEO and Alex Steele, take a listen to what he had to say.
The president is realizing all the efforts when he came into office of stopping offshore leasing, stopping drilling on federal leases offshore, New Mexico, both in the Bakken, in the Powder River. It's starting to backfire some. He's got to back off his rhetoric on federal leases going forward.
Anne-Marie, it's a private company. Ultimately, they can make some decisions, but they have to operate within a certain environment. And right now, this environment, as you put it, is somewhat hostile. But that was the objective, wasn't it? That's what I struggle with here. Wasn't that the ultimate goal, to make it hostile?
So the president campaigned on moving the country along away from fossil fuels and towards renewable energy. You see that in his Build Back Better economic agenda. Those subsidies for fossil fuel companies, that's going to get cut and is going to go towards intermittent energy sources like solar, like wind. The problem is, Jonathan, is that the administration is dealing with, obviously, the world turning back on. We're all back in our cars. We're back to flying. And there is obviously demand-supply issues happening. Also, the U.S. output is much less. At the same time, you have OPEC coming back online, but not as quickly. And you have seen a change in tone from this administration. And the president said that in Rome. He said it's not going to be a light switch. It's irrational to think that you're going to have just overnight a switch from oil and gas to those intermittent energy sources. The problem is that, as I've said and you've said, and you hear it from shale companies, the mood music coming from the capital towards these companies to want to invest more just isn't there. It's not optimistic.
Anne-Marie, thank you. Thank you very much. How much longer will this go on for? Here's the take of Ed Morse of Citi. Demand was going to be very slow in growing. The reverse is probably more true. We're seeing an uptick. Next year is going to be a very big surprise upward in terms of non-OPEC production, including from the US, larger than from any other individual OPEC country. I want to talk about this from the credit perspective with Mike Collins, from the equity side of things with Anastasia Amoroso. Mike Collins, first to you on credit. How does this energy story bleed into what you do every day?
Well, you generally want to own energy here, Jonathan, right? We've actually become more bullish on the energy sector over the last few months, right? Less supply, less capital investment, more demand, higher prices leads to better earnings, deleveraging by these companies, whether it's pipelines, which there's a limit on capacity there. So the pipeline companies are doing well, gas producers are doing well, energy producers are doing well, companies that have LNG facilities where they can export gas are doing well, right? So you want to be overweight energy, and we are here.
The energy sector in the equity market, Anastasia, up 54% year to date. It's flying. Is the equity proposition a little bit different for you?
No, I think Mike is right. The fundamentals of even equities in the energy space are very solid. What I would say is this is not what we've seen in 2015. This is drastically different. At these levels of oil prices and with the break-evens that are $45 or $50, and we got the price of Brent now crude above 80, you're making very, very solid cash flow and very solid profit margin. So that's why a lot of these companies are delevering, and that's why you have free cash flow that's really significant, and you see the return to shareholders. I mean, even in the equity space for the leading sector ETFs, you have 4% plus yield on energy. So it's very, very compelling. So I do like the sector a lot. As you mentioned, it is up 54% or so year to date, and oil has rallied a lot. So I think a lot of the policymakers around the world are looking for some release valves. And I'm not saying that oil is going to crash here drastically, but you've got a lot of event risk that's building up into year end. For example, you've got the talks with Iran that are coming up in the end of the month. You've got the rig counts in the United States that are moving higher. You've got OPEC that said they may change their reaction function, and that next meeting is in December. And then you've got President Biden that maybe is entertaining something on the strategic petroleum reserve release. So I think it's just a lot of near-term headline risks on energy. So this is why I say fundamentally, I do think you want to own energy equities. It's one of the better inflation hedges. Yeah. And these companies are profitable, but I would just look to step in maybe when some of this headline risk is a little bit behind us.
iCapital's Anastasia Amoroso. Anastasia, thank you. To Mike Collins of PGIM, thank you to you both on this Payrolls Friday. More all-time highs in this equity market. The S&P 500 up 0.7%. The NASDAQ marching higher too. From New York City this morning, good morning. Your trading diary's up next. This is Bloomberg.
PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
Look, so far so good in this equity market. What are we, 26 minutes in? An equity market that's fueled by better data in America, the ISM earlier this week, payrolls this morning, and a chairman pledging to be patient with loose monetary policy going forward. Equities up 0.7 on the S&P, 7 days of gains. On a NASDAQ, up for a 10th straight day of gains. We advanced there about 0.5%. Let's get to the trading diary. The president speaking on this payrolls report, 10:15 Eastern time. All eyes on the House. Will we finally get a vote on that economic plan? Powell, Harker, Evans all kicking off the Fed speak from Monday. CPI on Wednesday. Disney earnings too. The US bond market closing for Veterans Day on Thursday. And finally, the University of Michigan Consumer Sentiment Survey this time next week from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But what that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Friday the 5th of November, 2 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Taylor Riggs in for Alex Steele today. Alex has a well-deserved day off. Welcome, everybody, to Bloomberg Markets. Taylor, a really solid jobs report coming out of the United States. I suspect the White House is going to be okay with this, probably happy with this. We are certainly seeing the Fed probably on board with all of this. And the markets seem pretty comfortable as well. Stocks higher.
You could say that, to say the least. I know Mike McKee's going to nail it when he talks about the Goldilocks scenario that the markets and the Federal Reserve are seeing. But at least for now, Guy, it is a record high pretty much across the board. And it is a Russell 2000, that sort of domestic cap focused equities that are really taking the lead here. You're up about 1.5%. We'd be remiss, though, not to mention the 5-year yield. You came down a lot, almost 9 basis points yesterday. You're coming down in yield again by about 3 basis points or so. So you're now coming from a 120 just a few days ago to below a 110, a 108 on the 5-year, as perhaps maybe the markets are thinking they didn't need to price in as many rate hikes. Perhaps maybe inflation might cool off. How are we thinking about the Federal Reserve on days like today? Guy, I do have to mention one stock, of course, that we were looking yesterday after the close. It shares of Peloton. You're off more than 30% now, below $60 a share. You want to talk about supply chain issues and then perhaps demand given this reopening of the economy?
Yeah, I think they've been really caught on the hop by what has happened here and the speed of the slowdown that we've seen. Certainly that was the mea culpa from management on the call that we heard a little earlier. Fascinating to see how things have changed as quickly as they have for Peloton. Definitely maybe caught on the hop there. OK, let's talk about the top stories. We've mentioned jobs. Mike McKee watching that huge jobs beat. Strength in the US labour market, but wages pretty high. Ira Jersey on the bond market reaction. We are seeing a bond market reaction today. Yesterday, maybe driven by the Bank of England. Today, firmly focused on the United States. And Emily Wilkins watching House efforts to move closer to a vote on the bills that need to go through for the president's economic agenda to take a step forward. Let's deal, though, with the details of the October jobs report. Mike McKee, walk us through what your takeaways and what we learned today.
Well, you can see what everybody's takeaway is in the markets today, because the news was unabashedly good from the October payrolls report. Not just the 531,000 jobs that we got restored in October, but look at the revision. This was 194,000 the prior month, and now it's been revised up to 312,000. A total for September and August of 235,000 extra jobs. That's a whole month's jobs report. That's good news. We also saw a small increase in the labor force, not a whole lot, but a lot of people got jobs, and that pushed the unemployment rate down to 4.6%, which falls into the good reason for unemployment to fall category. This is the one issue that we still have. Participation rate doesn't move, 61.6%, which means that employers are having to pay up, and you can see 4.9% on a year-over-year basis. What were the most interesting job categories this time? Well, you have to look at the services industries, because the services industries really saw some changes. 496,000 overall, a bunch in retail, and we've been watching food and drinking places. 119,400 could be higher, but remember, a lot of cities, we haven't seen everybody return to the office, so you don't need those restaurants around all those office buildings. Healthcare and social for years was the leader, still at 46, and this is the question: what happened with 65,000 jobs being lost in education?
Thank you, as always. Bloomberg's Mike McKee, really appreciate it. Guy, I mean, look, over to you.
OK. Yep. We are obviously watching very carefully what the implications of all of this are for politics. Taylor, I've got a key question. Why aren't the president's polling numbers doing better if we have such a strong labour market? Normally, it's the economy, stupid, isn't it? That doesn't seem to be a factor at the moment. One of the reasons for that, I suspect, are the missteps that are taking place surrounding his economic plan. Emily Wilkins, Washington correspondent at Bloomberg Government, joining us now. The House is trying to figure out how it's going to make some progress today, both on hard infrastructure and human infrastructure. My question to you is, Emily, what is the Senate going to do when those markups arrive at its door?
But whatever happens, whatever the House brings to the Senate, we know that the Senate is going to change it. And that is why today there's still a lot of confusion in the House about whether or not a vote is going to happen. You see moderate members who really want to know that what they pass the Senate is going to get done. You also see moderate members right now with Speaker Pelosi saying we need to see the actual scoring for this bill. How much is it going to spend and how much is it going to raise? So still a lot of questions about whether we're going to see a vote today.
Okay, we'll see, we'll watch, we'll cover with interest. We need to get back to the Labour report because we've got a great guest lined up to talk about it right now. That, of course, is the Labour Secretary, John Ferro.
Thank you, team. Secretary Walsh joining us now on the Labour market report we got a little bit earlier this morning down in Washington, D.C. Secretary Walsh, great to have you with us on the programme, sir. I just wanted to start right here with a wage story. We heard from the President of the United States in the past week on this. Just listen in with me about what he had to say. Take a listen.
The wages have gone up higher, faster than inflation, and we have generated real economic growth. It doesn't mean these dislocations aren't real. They do affect people's lives.
Secretary Walsh, he said wages have gone up higher, faster than inflation. What data is the President looking at, sir?
No, I think what the president was really talking about is inflation is reflecting our economy reviving, and we're seeing this is a worldwide issue. I mean, certainly we've seen over the last couple of months wages increasing. We've seen that number catching up to inflation, not quite there yet, but it's heading towards that number. Again, I can't predict what's going to happen over the course of the next 6 to 8 months, but there's obviously a hope. All I can say is that the president laid out a plan in January for an economic recovery. Since that time, 5.6 million people have gone back to the workforce. This month's report, there's a lot of positives in it because it's a diversified group of businesses that have seen increases in their job market, in manufacturing and business-related issues, in a whole bunch of different sectors, in healthcare. It's not just in hospitality. So, I still think that we're moving forward. I didn't hear the president's whole speech there, so I'm assuming there was some context before and after what he said.
Well, I don't think the context is really relevant when you have the statement there for all to hear, for all to see. We listened to the whole news conference ourselves. He said in his words, the wages are growing faster than inflation, and sir, I don't see that in the data. I've had some uncomfortable moments in the past with the previous administration when they used to say things that weren't accurate. It's not accurate to say, is it, Secretary Walsh, that wages are rising faster than inflation in America right now?
Well, certainly in the last couple of months, and I asked that question this morning when I sat down with our economist team, and I was asking them about wages, growth, and inflation. And clearly, in the first part of this year, we saw some inflation going higher than wage growth. In the last couple of months, we've seen some of that changing. So hopefully, that trend continues.
Let's talk about the participation rate.
I don't know if that's what the president was referring to.
The president's statement is the president's statement. It's not backed up by the data on my screen. I've got inflation with a 5 handle and wage growth year over year. I've got growth of 4.9%. Secretary Walsh, I want to talk about the vaccine mandate as well. You've put that out there in a US Today piece earlier this week. The participation rate is not recovering in America. I want to understand from your perspective how you think that mandate is going to impact potentially that data point.
Well, this report today shows that about 3.8 million Americans are directly not coming back to work because of the pandemic. That's their reasoning for not coming back. And what we put out yesterday in the emergency temporary standard wasn't a mandate. It was companies over 100 people either vaccine or testing. And there's an option here. And that's what we're pushing for here, hopefully to see. And hopefully when this gets put into effect and it goes into full effect by January, we will start to see hopefully some of those 3.8 million people who right now are saying they're not coming back because of the pandemic. We'll start to see those folks feel safe enough to come back into the workplace. So it's a vaccine. If you don't get vaccinated, you get tested, and then in the workplace, you have to wear a mask. And in your own area, you can take the mask off. But it is about protecting the health and safety of workers.
I'll avoid the semantics, and I want to focus on a Goldman Sachs piece you referenced in the USA Today piece. Secretary Walsh, when you referenced Goldman Sachs, can you walk me through the conclusion of that piece that you referenced in that op-ed piece earlier this week?
Can you say that one more time? I'm sorry, I missed that.
Yeah, you referenced the Goldman Sachs piece of research on what would happen with some of the policies if they were introduced for labour supply. Can you walk me through the conclusion of that piece?
Well, what we're seeing is companies that have put in place vaccine mandates, and this isn't a mandate, but they put them in. We've seen 80 to 90% participation rate of people getting vaccinated, and we're seeing people go back to work. I mean, it's happened all across this country in those cases. And again, this is about making sure that we wanted to do, and what that op-ed was all about was really trying to explain to people that we want to create safe working environments so people feel safe about going back in. I would rather be talking about something else today in this period of time in history, but unfortunately, we're still living in the midst of a pandemic, and I think that we can't overlook the fact that people are afraid to go back to work. That's one of the reasons. There's other reasons, childcare and other reasons, but I think today's report is positive, and we just have to continue to build up the momentum off of this report.
I want to read out the conclusion of that Goldman Sachs piece that you referenced in this piece earlier this week. The research from Jan Hatzius and his team. Here's the conclusion. We are therefore not adjusting our employment forecast, but we see some downside risk to employment at the end of 21 and upside risk by the end of 22 as a result of the mandate. Now, I want to understand from your perspective, Secretary Walsh, do you accept that as you introduce these policies for supply in the labour market, there is some near-term downside risk, but ultimately, potentially, further down the road, some upside potential?
I don't think this has any upside risk. I mean, I think that this is clearly all a positive that we're doing here. I mean, what we're doing is we're asking companies with 100 or more people to have their employees vaccinated, or if they're not vaccinated, tested. And I think that we can't forget that a year ago this time we had people dying in this country at high numbers. We had high infection rate and high numbers. Since this pandemic began, 750,000 Americans have died. 5 million people in this world have died because of a pandemic, and I think that by putting an emergency temporary standard in place isn't going to impact our economy in a negative manner. If anything, it's going to have a very positive impact on it.
So just to be clear, are we cherry picking the bits we like of the Goldman Sachs research and not the conclusion? I just want to finish there, Secretary Walsh. Is that what we're doing here?
No, I wouldn't necessarily am cherry picking anything. I think I'm just stating a fact about. I think people are cherry picking what we did with the ETS, and I don't think that we have to look at the whole plan here. It's just like me coming on here today and talking about 531,000 jobs is a good report. Last month I was on, it was 193,000 report. If I only focus on the good reports and didn't focus on the bad reports, that's cherry picking. I don't cherry pick. I come straight at it.
Hopefully we get more of the same, sir. Thank you for joining us today, Secretary Walsh.
Thank you.
The Labour Secretary. Thank you, sir. As always, from New York City, it's back to you.
Thank you, as always, John Farrow there. And coming up, Heidi Shearholtz, Economic Policy Institute Director of Policy and a former chief economist at the Department of Labor. On today's jobs numbers, we're going to do that next. This is Bloomberg.
When you use Ecosia and click on it, we make money. But now there's a big difference compared to other search engines. We use the money to plant trees all over the world where they are needed most.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
111 million people use Twitter every day all around the world. 20% of those are in the United States. The top of funnel is really healthy. So we get a lot of at-bats, and we just need to keep doing a better and better job of converting people to help them make Twitter part of their daily ritual.
Live from New York, I'm Taylor Riggs. We have Guy Johnson in London, and this is Bloomberg Markets. And Guy, of course, it is the big news of the day. The U.S. labor market getting back on track last month. You had a larger than expected gain, and U.S. employers added 531,000 jobs in October. Joining us for a better look at the numbers, Heidi Shierholz, Economic Policy Institute president of that policy and senior economist, of course. And Heidi, so great to have you talk to us. This has sort of felt like sort of the Goldilocks for at least the markets and the Fed. How are you looking at these numbers this morning?
The numbers that we saw this morning were a really nice start to November. Job growth picked up to over 500,000 jobs, 531,000 jobs added in October. And then the key thing was that there were big upward revisions to prior data. And so, we had seen in prior releases, in like preliminary releases, a big decline in the prior 2 months, and those have been revised up. So over the course of the last 3 months, we've added 442,000 jobs on average. That is lower than the pre-Delta period. Job growth pre-Delta averaged over 700,000 jobs a month for 6 straight months in a row. So we're not there yet. We're still climbing out of Delta, but we're seeing very strong growth. This was just a really solid report.
Heidi, therefore, should we be comfortable with the fact that the participation rate is still relatively low? As you say, we're still climbing out of Delta. We've got good news today out of Pfizer in terms of one of their therapeutics. We're going to be vaccinating younger children. Your expectation would be that the people that are still out of the labour market, that are so critical to getting the supply side of the labour market to be functioning properly, will ultimately come back.
Yes, they will ultimately come back, but the question is when. So right now, this is not a small issue. Right now, if we had the same labor force participation rate we had pre-COVID, we would now have 4.4 million more people in the U.S. labor market. So it is big, but what we know is that millions are still being kept out of the labor force because of ongoing health concerns, and childcare is still not up to adequate levels. And, we've already seen this school year thousands of closures. All of those things are keeping thousands of school closures. All of those things are keeping parents still out of the labor force. So we do have some very COVID-specific backlogs. And then the other thing is, even in the aftermath of even normal recessions, the labor force participation rate resolves more slowly than the overall unemployment rate. That's definitely what we're seeing here. But I have every reason to believe that it will, as COVID gets in the rearview mirror, as we come out of this, it will resolve. The question is, how long will that take? One thing that's actually a point of good news as far as labor force participation goes is the Build Back Better plan that's being discussed right now. That has a lot of features in it that will actually boost labor force participation in the long run, like childcare and on and on. So my guess is that we'll actually bounce back to higher than we were pre-COVID.
It also has that plan in terms of fiscal policy to introduce more inflation in this economy. We notice wages as well are perhaps more sticky than they are transitory. How are you viewing less than transitory inflation?
Yeah, no, that's a really good question, because we're seeing an uptick in inflation, but there's not a match between where we're seeing strong wage growth and where we're seeing inflation. So it's not that the strong wage growth is driving our inflation numbers. So, for example, the biggest wage growth we've seen is in restaurants and bars. Nobody's talking about a massive inflation in restaurant prices. The inflation that we're seeing is like around the auto sector, where we aren't seeing the big wage increases. So it's not that higher wages are driving inflation. That's very COVID specific, like a big surge in demand for goods and supply chain issues. So I'm not so worried about so we do see that disconnect between wage growth and job growth, but it is true that wage growth isn't going to immediately go away once COVID is in the rearview mirror, because wages are a little sticky, which is good for workers.
Heidi, can I just take you back to the human infrastructure, the social spending plan that the president is trying to push through the House today? maybe the Senate further down the road. Are you suggesting that if that plan were to fall flat and ultimately end up not looking like it does currently, that we may have a productivity and a participation problem further down the road if that plan doesn't go through?
I think that's a very good question. I think it's less that we'll have an additional problem. It's more like we won't be able to go farther than we are now. I think our labor force participation will resolve from the aftermath of this recession, but we do have this longer run issue of low labor force participation in the United States, particularly among, for example, prime age women compared to peer countries around the world that actually have better things in place for childcare, healthcare, the kinds of things that make it possible for parents to fully participate in the labor force. So I think we will get, even without the Build Back Better bill, we will get back to pre-recession labor force participation rates. The question is, will we be able to go further? Will we be able to catch up to peer countries around the world that the U.S. lags so far behind in things like women's labor force participations?
And on that issue of inequality, we take a look at a breakdown of the different demographics as well, and that's really been the focus of the Federal Reserve, is looking at a labor market that's full employment for all, right, instead of just maybe some of the historical metrics. And yet if you focus on that and you let inflation run hot, it is a tax in some ways on the middle class. How are you thinking about a focus of some of the inequalities and the unemployment metrics there?
It's a really important thing to do, to look not just at the overall unemployment rate. It's a very useful measure. I look at it constantly, but we also need to dig deeper. And when you dig deeper, it really does unmask huge disparities in our labor market. So, for example, the overall unemployment rate right now, 4.6%. The unemployment rate for white workers, 4%. The unemployment rate for black workers, 7.9%, almost double. And it just underscores the issues of, occupational segregation, discrimination, other factors related to structural racism that lead to these very disparate outcomes. And so it's really important when we talk about recovery and how do we measure recovery that we're taking into consideration the fact that the overall unemployment rate really does mask big differences.
Yep, that's a hugely, hugely important point. A long road ahead to fix it. It would be nice if it was shorter. Heidi, we're going to leave it there. Thank you very much indeed. Heidi Shearholz, the Economic Policy Institute President. We greatly appreciate your analysis. What are we going to be doing next? Betting on software. Traders, Taylor, pouring in to tech software sector ETFs. More on that story next. This is Bloomberg.
Engine number one was able to do on the Exxon fight. It opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of the ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From London, I'm Guy Johnson. Taylor Riggs over in New York. This is Bloomberg Markets. Taylor, investor preferences starting to change a little bit around this earnings season, with software becoming apparently a much more attractive place to be
better
parking
than
capital.
bonds.
Well, that's a fairly low bar. Let's put it that way. Dave Wilson, ETF Friday, looking at this move.
Absolutely, Guy. And focusing in on an iShares fund, it's got one of these sort of ungainly names, iShares Expanded Tech Software Sector ETF. The ticker, IGV, a lot easier to work with. It's been around for 20 years, has about $6.7 billion in assets. And, you know, some familiar names among the biggest holdings, Salesforce, Microsoft, Adobe. But, you know, beyond that, I mean, you got a whole lot of smaller companies as well, 120 stocks or so in this ETF. And if you look at the numbers for October, a record inflow, $527 million. And we had a report out yesterday saying hedge funds are sort of moving in that direction. And you can understand it. I mean, this is a group that's done relatively well by comparison with the S&P 500. And you know, latest earnings reports out of companies like Cloudflare, Datadog, and Fortinet, all in cybersecurity, well received. Bill.com, too, higher after earnings as well, certainly helping this ETF's fortunes.
Thank you, as always. Bloomberg's Dave Wilson on our ETF Friday. Guy, you continue to look at these equity markets. I think we're on the 63rd not straight, but 63rd record high that we've had this year, at least on the S&P 500. Dave Wilson's nodding his head, so we're going to go with 63. It is unbelievable, just this sort of lift up that we continue to get. We're going to continue to do all of this next segment as well. Stocks are rising on those jobs report. Our next guest saying continue climb the wall of worry. This is Bloomberg.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images we can live the violent emotions of hell, the weight of purgatory and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside, so it's about using technology, pixels, and binary code with a human and humanizing content.
supply chain team's done a great job on semiconductors. We've been able to secure semiconductors for our entire business globally and been able to keep all of our installations globally, which we do almost 10,000 every day, somewhere in the world, all on track.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Continuing to look at record highs across the board, Guy. As we mentioned before, 63 now record highs this year alone for the S&P 500. Let's do it all with Abigail Doolittle, who has more, and also taking a look at some of those yields, I know.
Indeed, Taylor. And it's really pretty incredible because we do have stocks higher once again. This lift-off, this melt-up just absolutely continues. The S&P 500 up 0.7%. And a big piece of it, as you know, Pfizer on this very encouraging news around their COVID pill. Some saying that this is the end of the pandemic as we know it. Up about 7.5% off the highs at that time, up 10%, and at one point up 13%. At that point, the best day ever for Pfizer. Either way you slice and dice it, very strong. We also have the Russell 2000, that reopening trade, outperforming, up 1.1%. Now, it's interesting because the tech-heavy NASDAQ, which is really growth, but last year had a little bit of that stay-at-home feel, it's underperforming just a little bit, but still, it's up 0.5%, and it is up for a 10th day in a row, the 8th record closing high. If it closes higher, it seems like it will at this point in a row. What we're looking at here in white is that NASDAQ 100, the longest winning streak of the year since December of last year. Below, we're looking at the 10-year yield, down, down, down. And of course, as yields go down, that makes the valuation look more attractive for stocks. It also makes assets, in particular growth assets, more valuable as discount rates come in. That's the dynamic that we've seen going through this year, and we're certainly seeing right now. And in fact, if we take a look at it from a correlation standpoint, Guy, when we go into the Bloomberg terminal, we are going to see, not surprisingly, that as yields have come in so quickly, the correlation between yields and stocks coming down, that has been the story for much of the last 2 years. And when it's been positive, that's been a more volatile time period for stocks. Yeah. It's unclear whether that's going to remain, but right now it does look like we have more smooth sailing ahead for stocks and tech in particular.
Yeah, it kind of feels like that. It's amazing, isn't it? The narrative that we've got going on here, considering as we indicated right at the top, just how many record highs we've had. This market just continues to push ever upwards. Immune, it seems, to all the news flow and the noise around it. Essie Dweck, Flowbank's CIO, joining us now to give us her take on all of this. Essie, let's just talk about that payroll number. What does it mean for investors?
Basically, it's exactly where you would want it to be. It's not so high that you worry that the recovery is suddenly much stronger and the Fed has to review its tapering path. And it's definitely strong enough to show that the recovery is picking up again, especially if you add that in with the revision for the previous month. After the summer lull, we are seeing improvements. Vaccination is helping. People are getting back to work. And altogether, I'd say, if anything, this was in line kind of with expectations, a bit stronger, but exactly what you would have wanted to see.
How are you thinking, though, about valuations now that we're at record highs across the board?
So you really have to frame the valuation picture. It actually hasn't deteriorated so much recently because your earnings have been so strong. So they tend to be high, but I don't think in and of themselves they're an obstacle to higher markets. They're just not enough of an argument for markets not to move higher. So when you look at the context, you look at the reopening, you look at the strength of the markets, you look at the strength of earnings, it's not surprising that valuations are expensive. You have a lot of liquidity as well, but again, not an obstacle in my opinion. And as long as earnings remain strong, then there's still upside potential.
The market feels a little broader. We are starting to see small caps in particular actually showing some decent momentum here, breaking out. Russell's pushing higher through records. How good a sign is that is happening, that we do have a relatively broad market story and that finally small caps are back participating in it as well?
It's very good news. Absolutely. We have, especially when you consider that tech is managing to do quite well at the same time as the small caps. It's a broader market. It's really coming to this story that there was a big wall of worry. There were a lot of concerns all the way through September and October. The Delta variant, supply chain disruptions, inflation staying higher for longer. You had all of these hurdles coming in for investors. Obviously, the political or the debt ceiling and the infrastructure packages as well. And most of those, I think we've probably seen the peak in those fears. And that's also why this rally is broadening. And I think that's why it can continue into the end of the year.
What about a peak in yields? It's been pretty unbelievable, the moves that we've had down lower in yield yesterday, and that continues today.
It's really, I think, starting to maybe go back to this don't fight the Fed view. The Fed has been very clear. They want to break between tapering and rate hikes. They announced tapering in line with expectations. They're going to keep an eye on inflation, but they still think it's transitory. They still think it will abate at least in the second half of the year, if not sooner. And if you think about it, rate hikes are not necessarily the best tool for what we have right now, right? We have a supply problem more than anything else. So I think that the Fed is sticking to what it said for a number of months now, and the market may be starting to realize that a little bit. Maybe the last thing to keep in mind is growth is going to be slowing next year, and probably even more so in the second half of next year once all of this reopening hopefully is behind us, because we are moving past this pandemic. It would be very weird timing for the Fed to be so aggressive.
Can I just talk a little bit about that moving beyond the pandemic? What do you make of, how important is the news out of Pfizer today? Pfizer has a pill that is 89% effective in keeping people out of hospital. How big a kind of step forward is that in terms of getting this economy to re-accelerate or accelerate the process of reopening? Strikes me as being huge news here.
Absolutely. And any news in this direction has been really encouraging. When you start to have treatment in addition to vaccines that are working, it means more and more tools to fight this pandemic. It means more and more possibilities of getting back to normal with more confidence, with less fear. We know workers have stayed out of the labor market due to some fears, due to taking care of family that might have had COVID or having it themselves. A lot of these quarantines, if you think globally. So it's very encouraging news, and anything we get in that direction is just going to reinforce sentiment and reinforce the outlook for the first half of next year.
Esty, we're going to leave you there. Great stuff. Always appreciate your analysis. Thank you for joining us from Geneva. Esty Dweck of Flowbank. Greatly appreciated. I mentioned it just a moment ago, Taylor. We're going to talk more. The Pfizer pill, promising. Huge promise in terms of the story of the journey out of this pandemic. It's just, I think it's a game changer here, what we're seeing in terms of the impact that it could have. We'll talk about that next, and we'll get the president's perspective on this labor market as well.
We're going to be listening into that, and we'll see hopefully just the next few minutes or so. We're waiting for comments on pretty much, Guy, was better than expected and a very good jobs report that we got for the month of October. This is Bloomberg.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and of course some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. The House plans to vote today on President Biden's $1.75 trillion economic package and a separate infrastructure bill. Intense 11th hour negotiations by Speaker Nancy Pelosi appears to have settled lingering differences. Pelosi garnered support for the vote after promising 3 potential holdouts that she would make protections for immigrants a top priority once the House finishes with Biden's economic agenda. A company owned by the Chinese government is working on an offer to acquire Hong Kong's influential South China Morning Post, the city's most prominent English-language newspaper. Bloomberg has learned Bohemia Culture is interested in a deal with Alibaba. Bloomberg News reported in March that Alibaba has come under intense pressure from the Chinese government to divest some of its media assets, including Cmpro. And Germany is reporting record COVID-19 infections for a second straight day as a fourth wave of the virus spreads across Europe. The surge is threatening to overwhelm hospitals in some hotspots and prompted Chancellor Angela Merkel to express a deep concern about the course of the pandemic heading into the winter. It could also potentially interfere with coalition talks led by Olaf Scholz to form a new government. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Guy.
Yep, it could definitely become Olaf Scholz's problem very, very quickly. Ritika, thank you very much indeed. Let's tie what is happening with the virus, the spread that we're seeing at the moment in Europe, the story in the United States, and kind of talk about the Pfizer news and how this all impacts the labour market. So the latest jobs data out this morning out of the United States, certainly showing the labour force participation rate unchanged. Now, that's a huge deal. That number needs to improve. The US Labour Secretary, Marty Walsh, joining John Ferrer a little bit earlier on this hour, talking about the fact that the virus remains one of the main reasons why people may not be going back to work.
What we put out yesterday in the emergency temporary standard wasn't a mandate. It was a companies over 100 people either vaccine or testing, and there's an option here, and that's what we're pushing for here. Hopefully to see, and hopefully when this gets put into effect and it goes into full effect by January, we will start to see hopefully some of those 3.8 million people who right now are saying they're not coming back because of the pandemic. We'll start to see those folks feel safe enough to come back into the workplace.
Marty Walsh, the Labour Secretary, speaking a few minutes ago here on Bloomberg Television. We've also had some incredibly positive news in terms of the fight back against COVID-19. Pfizer's COVID pill, a new pill they've come up with, this is a therapeutic, remember, not a vaccine, and the effectiveness could be an absolute game changer. 89% effective, this pill, in preventing hospitalizations for those that have contracted COVID-19. That sounds like a very, very high number to me. Bloomberg senior healthcare reporter Drew Armstrong joining us now on the line to give us his analysis. Can you just give me the kind of the magnitude, Drew, of the impact that this therapy from Pfizer could have?
Well, I mean, I think you said it. This is a really big deal here, and 89% efficacy is incredibly strong. I mean, you know, Merck not too long ago came out with a anti-COVID pill that showed 50% efficacy, and people were saying this is fantastic. 89% efficacy is, you know, I mean, obviously a magnitude of improvement on that, and I think to, you know, get these type of breakthroughs coming kind of one after another, in particular, along with all of the good news that we've had about vaccines over the last year is, I think, an incredibly important step for where we are in the pandemic. I was actually just looking. It was almost exactly a year ago today that we got the Pfizer results on the vaccine.
Drew, talk to us about pricing. I'm getting a lot of comments from viewers saying that if pricing for the vaccine is significantly lower than pricing for a pill, does the pill still remain a sideshow? What are pricing conversations looking like?
Well, you know, I think we don't know the price yet, but what Pfizer has said is that they will kind of follow a similar strategy to what they've done with their vaccine, where, you know, wealthier countries pay a higher price, and lower income countries and middle income countries pay a little bit less. Lower income countries pay less than that. With their vaccine, they've adopted what they call a not-for-profit strategy. I think it has yet to be seen if they will do the same thing for these, for the pill. Obviously, these are a lot cheaper to manufacture, but you know, in general, treatments for diseases that are pills, when they're not, in generic form, they tend to be more expensive than a lot of what we see with vaccines. So, you know, I think that remains to be seen and is going to be very, very carefully looked at.
In terms of what we should see going forward from here, there's huge concern in Europe. We're starting to see rising case counts pretty much across the whole continent. The UK is led, but we're now seeing a pickup in places like Germany. Really kind of big numbers starting to be posted again as we go into winter. Is this the moment, though, a bit like, as you say, a year ago when we got that first amazing Pfizer news in terms of the vaccine, is this the moment that we can actually, with some degree of certainty, talk about moving from this being a pandemic to being an endemic problem that we can learn to live with?
I think, you know, listen, what I'll say is that I thought that when we had the good vaccine news, and then here we are a year later still dealing with this thing. So I think this is phenomenally good news. I think we have all also learned not to underestimate Mother Nature, when in particular with regards to this virus. You know, and we do have things that come up out there, like drug resistance and things like that that are real problems. And remember, you know, I mean, a pill like this is only as good as the access is. I don't think we are done with the pandemic, but gosh, it is good to have, presumably once this gets cleared for use, which I assume that it will be given these results, it's going to be good to have another tool in the toolbox here for sure.
Drew, what are you expecting as well? Push forward to Monday. I believe the U.S. is reopening for a lot of international travel that up until this point has been pretty much halted and grounded to a stop. How much of this certainly helps, at least some from the economic angle, but do you get any concerns about health as well?
You know, I always, at least in recent months, found these travel restrictions to be kind of interesting, just from the standpoint that, you know, if they're meant to stop COVID patients from coming in. Like, we already got plenty of COVID patients here in the United States. So I think it's, from a economic standpoint, from a going on vacation standpoint, it's certainly good to see some of these restrictions begin to fall and for the world to start opening back up a little bit more. We track travel restrictions every week here on the Bloomberg Travel Tracker. One of my favorite things to work on and kind of figure out where the heck can I go over the next couple of years or weeks or months when it's finally time. I'm trying to take my wife on a trip sometime soon. So, it's very nice to see these restrictions coming down, especially in light of the fact that, if this was meant to stop COVID from coming in, a lot of places, COVID is very established inside, almost everywhere in the world right now. It's not clear to me what a travel restriction at this point in the pandemic really, really accomplishes from kind of a broader public health standpoint.
There's a travel tracker, and Drew, as always, the Bloomberg Terminal gives you a turnstile MTA tracker, a TSA airport tracker. We really do it all, and we do that with our assistance from Drew Armstrong. Really appreciate it. Thank you. Stay with us, because coming up, Guy, we are still awaiting President Biden's remarks on the October jobs numbers. We're going to bring that to you live in just a few moments. This is Bloomberg.
Today's $2 billion buyback is an important step, I think, and it shows confidence that we have in the underlying performance of the business and outlook, and shows a commitment to try and normalise our capital base.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Rishika Gupta. British Airways parent IAG says cash flows turned positive in the third quarter and that North Atlantic demand has begun to surge as the US prepares to reopen its border to vaccinated Europeans next week. IAG says long-haul bookings are now recovering faster than its short-haul sales. And it says the premium leisure segment is doing particularly well at British Airways and the Spanish arm Iberia. Peloton shares tanked more than 30% in pre-market trading in the US. Analysts say the home fitness company's results and reduced guidance implied weaker demand than expected. Peloton slashed its annual revenue forecast by as much as $1 billion and lowered its projections for subscribers and profit margins. The company admitted it underestimated the impact of economic reopenings. And the US Justice Department is looking into whether Credit Suisse is complying with a 2014 guilty plea. And that's your business flash, Guy.
Ritika, thank you very much indeed. The President is speaking on the jobs report. Let's take a listen.
Unemployment rate has fallen again today, down to 4.6%. This included a substantial drop in unemployment for Hispanics, which was much needed. Our economy is on the move. This morning, we learned that in October, our economy created 531,000 jobs, well above expectations. We also learned that job growth over the prior 2 months, August and September, was nearly 250,000 more jobs than previously thought. In total, the job creation in the first full 9 months of my administration is about 5.6 million new jobs, a record for any new president. That's a monthly average of over 60,000 new jobs each month, 10 times more than the job creation at 3 months before I took office. New unemployment claims have fallen every week for the past 5 weeks, are down by more than 60% since I took office, and are now at the lowest level since the pandemic started. And people continue to move from unemployment rolls to work. Unemployment has decreased this year by more than any other year since 1950. So any year since 1950, unemployment has decreased more in this year than since 1950. And not only are more Americans working Americans are seeing their paychecks go up. Weekly pay went up in October, with an average hourly earnings up almost 5% this year. That's more than some of the lowest paid workers in our country, men and women who work in restaurants, hotels, the entertainment industry, have seen their pay go up 12% this year. Over 5.5 million jobs. Unemployment down a record pace to 4.6%. And before we passed the rescue plan, forecasters said it would take to the end of 2023, to get to 4.6 unemployment rate. Today, we've reached that rate 2 years before forecasters thought it was possible. I would humbly suggest this is a significant improvement from when I took office, and a sign that we're on the right track. This did not happen by accident or just because. We laid the foundation for this recovery with my American Rescue Plan that Congress passed at the beginning of my term. It put money in working families' pockets. It gave families with kids a tax cut each month. It helped keep small businesses going in the dark days earlier this year. And it provided the resources needed to launch one of the fastest mass vaccination programs ever. We got more than 220 million shots in arms in my first 100 days. We didn't stop there. In recent months, we've started implementing vaccination requirements, which have helped bring the number of unvaccinated adults down in this country from around 100 million several months ago to 60 million now. You know, that's good for our health, but it's also good for our economy. Now, vaccinated workers are going back to work. Vaccinated shoppers are going back to stores. And with the launch of the vaccines for kids ages 5 through 11 this week, we can make sure more vaccinated children can stay in school. These plans I have implemented, through these plans of economic success, the economic rescue and vaccination plans, just both of them, have made the economy the envy of the world. We're the fastest growing major economy, and one creating jobs at a faster pace than anyone. Yet, yes, there's a lot more to be done. We still have to tackle the costs that American families are facing. But this recovery is faster, stronger, and fairer and wider than almost anyone could have predicted. That's what the numbers say. But we want to make sure that people continue to feel it in their lives, in their bank accounts, in their hopes and expectations for a tomorrow that's better than today. That's what it's all about. Making sure our recovery is fully felt. To determine that depends on two things that are entirely within our reach. The first, for our economy to fully recover, we need to keep driving vaccinations up and COVID down. In that effort, we took two major steps this week. On Tuesday, the CDC recommended COVID-19 vaccine for children between the ages of 5 and 11. We're prepared for this moment by securing enough vaccine supply for every single child in that age category in America. Those doses have started to arrive at thousands of pediatricians' offices, pharmacies, schools, and other sites. As a parent of one of the first children to receive a shot said, quote, "Today is such a huge sigh of relief," end of quote. Starting next week, our kids' vaccination programs will hit full strength with about 20,000 trusted and convenient places for parents to get their kids vaccinated. And yesterday, the Occupational Safety and Health Administration, OSHA, issued a rule to require employers with 100 or more employees to ensure that each of their workers is fully vaccinated or tests negative for COVID-19 at least once a week. And the Centers for Medicare and Medicaid Services issued a rule requiring that all workers at healthcare facilities participating in Medicare and Medicaid are fully vaccinated. Together, these rules, along with other requirements we've put in place, means that 2/3 of all workers in the United States are now covered by vaccination requirements. These requirements have broad public support, and they work. Already we've seen organizations that have adopted vaccination requirements increase their vaccination rates by more than 20 percentage points, often as high as over 90%. This is good for the workers, for their colleagues, for their loved ones, and for their communities. And it's also good for the economy. In a recent University of Chicago survey, every economist agreed that requiring staff vaccinations or regular testing among large employers would promote the economic recovery that is faster and stronger even than it is now. Analysts at Goldman Sachs project that these kinds of requirements could lead to up to 5 million more Americans re-entering the workforce. That's because they feel safer to do so. It's because there are fewer disruptions to things like childcare. Again, beating COVID-19 remains one of the most important ways to strengthen our economy, not just save lives, but strengthen our economy. And we're making progress. As of this week, 70% of American adults are fully vaccinated. More than 193 million Americans fully vaccinated. It was less than 1% when we took office 10 months ago. And one more piece of good news. Last night, we received promising news about another potent and potential COVID treatment, a pill developed by Pfizer that may dramatically reduce the risk of being hospitalized or dying when taken shortly after infection, if you're infected. If authorized by the FDA, we may soon have pills that may treat the virus of those who become infected. We have already secured millions of doses, and the therapy would be another tool in our toolbox to protect people from the worst outcomes of COVID. But look, it's important to remember, we need to prevent infections, not wait to treat them once they happen. And vaccination remains the best way to do that. The pandemic is not yet behind us, but within this week's announcements, vaccines for kids, more adults getting vaccinated, potential treatment for those who get sick, we're accelerating our path out of this pandemic. The second way to make sure recovery is fully felt is to pass my bipartisan infrastructure agreement and my Build Back Better plan, which are being debated now. And I'm going to be heading over there shortly after I do this press conference, back to my office to make some calls. I want to say very clearly, if your number one issue is the cost of living, the number one priority should be seeing Congress pass these bills. 17 Nobel Prize winners in economics have spontaneously wrote to me together and said this will lower inflationary pressure on the economy when we pass my bills. A new analysis from the Wall Street firm of Moody's Analytics found that it will ease the financial burden of inflation for middle-class families. Put another way, these bills will provide families with, as my dad used to say, just a little more breathing room. That's because the Build Back Better framework lowers your bills for health care, child care, prescription drugs, and preschool. And families get a tax cut. That's how you end some of the anxiety people are feeling about the economy. That's how we give people some breathing room. That's in addition to the infrastructure bill that will create millions of jobs rebuilding the arteries of our economy. And by the way, these two bills add up to the largest effort to combat climate change in the history of the United States of America. Right now, we stand on the cusp of historic economic progress. Two bills that together will create millions of jobs, grow the economy, invest in our nation and our people, lower costs for families, and turn climate crisis into an opportunity, and put us in a path not only to compete, but to win the economic competition for the 21st century against all comers. And passing these bills will say clearly to the American people, we hear your voices. We're going to invest in your hopes, help you secure a brighter future for yourself and for your families, and make sure that America wins the future in the process. I'm asking every House member of the House of Representatives to vote yes on both these bills right now. Send the infrastructure bill to my desk. Send the Build Back Better bill to the Senate. Let's build an incredible economic progress. Build on what we've already done, because this will be such a boost when it occurs. Let's show the world that America's democracy can deliver and propel our economy forward. And let's get this done. I'll be back to answer some of your questions when they pass, but may God bless you all, and may God protect our troops. Thank you.
Okay, you've been listening to the President briefing from the White House, following on from the Labour report we saw a little bit earlier on, referencing the fact that for things to continue along a positive trajectory, we need to very much focus, Taylor, on beating back the virus, focus on vaccinations. He talked about what is happening with Pfizer. He said it's imperative that we get the two parts of his economic plan passed, the infrastructure plan going to his desk, the Senate, he hopes, will pass ultimately the human infrastructure part of it, but I think that's kind of where I think things get a little bit sticky. But it's interesting, the president, in some ways, you take a look at his approval ratings right now, not getting much credit for a labour market that seems to be really getting into gear now.
How much of that is maybe some of the inflationary pressures, the higher goods that are impacting some of the consumers? You're certainly seeing that, at least within the markets, Guy, of how these companies within the earnings reports are able to pass on to the consumer the higher input costs that they are feeling. Some of those strong earnings that we have, Guy, here are pushing up the markets to some of the record highs that we continue to see.
Absolutely. Let's check on where we are with the markets right now. We are certainly seeing a bid back into the market again today. Further record highs being demonstrated on both sides of the Atlantic. Interesting as well that we are starting to see the small caps coming into gear. This is the picture here in Europe. The stock 600, 484 now, ever higher. Inching higher, but nevertheless, day after day, more gains being made. However, there is still the spillover effect, the hangover effect from yesterday's story surrounding the Bank of England. The pound remains on offer, 134.68. We continue to see yields coming lower when it comes to the gilt market as well. The Bank of England's governor saying he didn't bottle it yesterday, pointing towards the fact that we are likely to see a rate hike coming fairly soon, being backed up by Dave Ramsden today on that line and by the chief economist, Mr. Pill, over at the Bank of England. But nevertheless, the kind of the aftershock of what we got yesterday still being felt in the markets, Taylor.
Let's talk about the aftershocks that we're continuing to feel within the record highs that we have here, Guy. 47.13. You're up 0.7% on the S&P and the Russell 2000, Guy. This is those reflationary trades really focused on the U.S. market. That is the big outperformer, up 1.6%. Take a look at what's going on within the yield market, though. How much of this was a Fed on Wednesday? We got your BOE on Thursday, and really the market perhaps repricing a bit of a dovish tone, if I can say that. Perhaps maybe not as many rate hikes as we maybe thought before. A 107 on the 5-year. We were at a 120 just a few days ago, and a 146.87 on the 10-year yield. So we're below, again, sort of that 150 level. And Guy, if you just take a look at some of the stocks, when we think about what is reopening, that reopening trade, it is very clearly Peloton to the downside, Expedia, Airbnb, travel to the upside.
Yep, and you've got Pfizer to the upside as well, certainly benefiting there from that news surrounding its pill. But the vaccine makers broadly under pressure. The labour market, though, absolutely front and centre here. We've just been hearing from President Biden from the White House talking about the implications for his administration. Earlier, we also heard from Marty Walsh. He, of course, is the US Labour Secretary. He spoke about wage pressure in the system.
We've seen over the last couple of months wages increasing. We've seen that number catching up to inflation. Not quite there yet, but it's heading towards that number. Again, I can't predict what's going to happen over the course of the next 6 to 8 months. Clearly, in the first part of this year, we saw some inflation going higher than wage growth. In the last couple of months, we've seen some of that changing. So hopefully that trend continues.
Let's talk more about the numbers. Bloomberg's Mike McKee, international economics and policy correspondent here at Bloomberg, joining us now. The issue of wages is really important here. We are seeing wages remaining fairly sticky. They are elevated. What is it? 4.9% the number, but inflation's running at 5%. The labour market is definitely healing, but are we going to continue to see wages remaining as elevated as they are, Mike? And if they do remain where they are now for a few more reports, is the Fed going to have to rethink that taper plan that it's already laid out this week?
Well, it's an interesting question about the remaining the way it has been, because we saw a lot of companies raising wages to try to attract people back into the labor market over the last month or so, the anecdotal reports, and they did boost the wage rate. Now the question is, do they need to keep doing that? And with the number of jobs still, a number of people still out of work, they could continue to do that. One important point, though, is it depends on what inflation you're looking at. If you look at the PCE, which is the Fed's favorite indicator, or you look at the ECI, which we just got earlier this week, they both are running at about 4.2, 4.3%, so 4.9 is better than that. So inflation has passed that. Now, as you saw the president, I would have given him the advice, tout that as a gain for the working man. The question for the Fed is whether it continues or not.
Mike, interesting. I'm reading a note here from Green Economics saying that labor force participation is the sticky point for them, because unless participation picks up in the coming months, it'll take 3 months to then push the unemployment rate down to 4%. And then you're looking at a rate hike as early as July next year. Is it the labor force participation that you're looking at?
That's what everybody is concerned about. Why did labor force participation stall out? We had 104,000 people come back into what turned out to be a very good labor market, and there are obviously so many jobs open right now. If you don't get the participation rate up, if you don't get more people coming back into the labor force, you're going to have wage pressures, because it's going to be the only way companies can hire. And an interesting thing, the Fed has been saying they want this inclusive unemployment rate. They want the unemployment rate for blacks and Hispanics and Asians to go down close to where it was pre-pandemic. Well, the labor force participation rate for black workers actually went down. So that's not helping at all either. So maybe there's something somebody could do in a targeted way, but at this point, we're not at the Fed's criteria yet.
Mike, why is the US bond market, do you think, paying so much attention to the Bank of England? The Bank of England seems to be all over the place at the moment. We've heard from the governor today saying he didn't bottle it yesterday. We've heard from the deputy governor talking about that we are going to have to see rate hikes in fairly short order in order to ensure that we don't get second-round effects into the labour market. The message is confusing, and the bond market has been hugely volatile as a result of that. Why are we getting such a big reaction, though, in the US market from what is happening over here?
Well, I think it's a combination of things, and it's not just the decision from the BOE, but the timing this week. We've seen kind of all of the major central banks who reported this week take a punt on raising interest rates in the near future and suggest that they do believe inflation is going to come back down. And you'd had the British bond market repricing to the idea of a rate increase, and they had to take that out. The U.S. had done much the same. And so you're basically seeing people say, well, central banks aren't moving as quickly as we thought, and so maybe we've overdone it a bit.
Thank you, as always. Super smart. Bloomberg's Mike McKee taking us global. And speaking of going global, Guy, it is the World Health Organization that's warning that a surge of coronavirus cases in Europe has pushed the region back as the epicenter of the pandemic. Germany reporting a record number of virus infections for a second straight day. It's an ominous sign as colder weather approaches. Here with more, Sam Vazzelli, senior pharmaceuticals analyst for Bloomberg Intelligence. And Sam, are we still focused on cases, or are we focused on the treatment and a death rate of those cases?
Yeah, hi. Unfortunately, it seems to be that we're still focused on cases, which is what drives a lot of the policy across the various countries in the UK, Germany. Although Germany had previously started to talk about that they're going to focus more on hospitalization rates to drive their policy. So maybe this will be the test to see whether, as the cases rise, whether they take a different approach this time, or do they just go, oh my God, this is too much and we're going to have to deal with it.
What is going to be the policy reaction, do you think, if we do see cases going higher? I saw one of the states earlier on in Germany, the leadership there, talking about the possibility of further restrictions coming back in. Sam, do you think that's necessary at this point?
Yeah, I mean, to be honest with you, I don't know if there's appetite anywhere, including the UK and Germany, of course, for people to go back into hardcore restrictions in terms of limiting ability to get together and have a normal life. What could happen is that they might limit the type of gatherings which are mostly responsible for high levels of transmission, which is large gatherings in closed spaces. That could happen. They might limit the number of people in restaurants, etc. But frankly, we just have to move on and manage this as best as we can. And Germany needs to start thinking about getting more jabs in people's arms.
Yeah, Sam, I guess I'm confused why 18 months in we're still focused on cases if most of the policy experts have said, as you just say, we have to learn to live with this. And as long as the treatments are getting better, the Pfizer pill, for example, and we're not overloading the hospital systems, then you should just start to see life get back to normal. Why aren't we thinking about that?
Yeah, we should be. I mean, as somebody who's just come out of self-isolation, having caught COVID, and attesting to the fact that thanks to the vaccination, I've been able to get through it with basically having a pretty bad cold. All the limits that they put on people's lives, self-isolation for 10 days, and now, they suspend your vaccine pass. They really make life quite difficult. And then, of course, you're not supposed to take your PCR test for another 90 days in the UK, which means you can't travel. So putting all these other restrictions on, having just been through it, I don't think that we need to really worry about that level of infection. We need to worry about people.
Sam, this Pfizer pill, just kind of talk me through your assessment of the impact that it could have.
Yeah, so let's not forget, both of these pills have been tested in people who have a risk of being hospitalized. So they have some background disease or obesity or diabetes or something that increases the risk. And in this case, it obviously generated 89% efficacy or 85% efficacy if you look at it on the same way as Merck looked at theirs, which gave them 50%. So it is phenomenal to have these two pills available to people who would be at risk otherwise of being hospitalized, even if they're vaccinated. I don't think the vaccination status makes a huge difference. It just makes it harder to prove that your drug's working. So these will be very powerful tools in managing that pressure from the pandemic.
Moderna's down 22% now. It's having a massive impact in terms of the share prices and some of the vaccine manufacturers, which is fascinating to see. Sam, I'm glad you're feeling better. Have a great weekend. Bloomberg's Sam Fazeli of Bloomberg Intelligence. What have we got coming up for you? Taylor, we're going to talk to Caroline Simmons, UBS Global Wealth Management UK CIO. We'll talk about the implications of what we got from the Bank of England yesterday, the implications of the details from the payroll reports today, plus that Pfizer pill. Is that a game changer? We'll find out next. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
From London, I'm Guy Johnson, Taylor Riggs over in New York. This is Bloomberg Markets. Let's talk about the markets, Taylor, in a little bit more detail. A solid jobs report out of the United States today. Good news from Pfizer with its new pill and the efficacy that is delivering. We're still trying to figure out exactly what the Bank of England's doing, but we'll talk about that in more detail in just a moment. Caroline Simmons, UBS Global Wealth Management, UK CIO, joining us now. Caroline, let's start off with the big picture. You just had a really solid jobs report out of the United States. We're getting good news on COVID. I appreciate the cases are rising here in Europe. Equity markets continue to make fresh records on both sides of the Atlantic. Do you just stick with this, and how long for?
Yes, you stick with it as long as earnings growth is enough to offset any downward pressure on valuations from rising rates. And for us, that's at least a 12-month picture of positive equity upside. And we can come back to where rates are going depending on what the central banks end up doing.
All right. Well, I'm going to take your bait and go there because I can do bonds all day long with you, Caroline. It's interesting, the repricing that we've seen within the bond market, a big move down in yield within the U.S. here yesterday. That continues today. What is that telling you?
Yeah, it's... I think the markets were trying to, particularly the Bank of England, trying to get people to reprice the fact that rate rises were going to be coming at some point. Perhaps they went a bit too far on that, I'm not sure. And then obviously they didn't raise the rates yesterday, and that has influenced markets globally. I think it's sort of a bit of a unnerving situation for markets where some people are concerned about whether there might be a policy mistake. There's obviously quite a lot of noise in the data about labour markets opening post-pandemic. And the sort of fact that central banks, at least the Bank of England, has been a bit confused will not reassure markets. The Fed, however, did the taper as they said they were going to do and are messaging quite clearly. So hopefully that's not so much of a surprise for the markets.
Yeah, the Fed's managed to thread a needle thus far, but the tricky bit comes next, timing on the rate hikes, and that is where the Bank of England is really struggling. Caroline, do you think central banks are going to be a big source of volatility for markets going forward as we try and navigate this next phase?
Yeah, I think it does create intra-market volatility. So as we've seen, the headline equities, can continue to go up as long as we've got the growth and the earnings which we've got. But obviously the timings around rate rises and how quickly the rate rises happen does have an effect on the sectors within the market. So, for example, we saw yesterday, obviously in the UK, financials selling off because people thought they were going to raise rates and then they didn't. When they do get round to raising rates, then I would expect the financials to outperform again. So intra-market, it will cause volatility around expectations on when rate rises are coming. But at a headline level, I would think that the sort of growth backdrop probably just continues to drive equities higher.
How about geographically? Is it U.S. versus rest of the world, or are there better, less expensive opportunities globally?
Yeah, so our preferences are for Japanese equities and Eurozone equities at the moment.
Okay.
So we think that they are very cyclical markets. They've lagged a bit. In Japan, they've partly had a lower vaccination rate, which is now starting to pick up. They've obviously had all the political changes, which have been affecting markets. But for us, it's about sort of tapping into the cyclical parts of the market that are less likely to be affected by rising rates, because we know that over the next 6 to 12 months, rates will be going up. It's just a question of which particular month they go up in.
Caroline, we are seeing a case count climb here in Europe. Germany in particular now starting to see some quite big numbers being posted. Should that deflect me away from some of the cyclical elements within the market?
So I don't think it does for now. COVID, I don't think really has been driving markets in recent sort of weeks and months. It's more about inflation, supply chain disruptions, and monetary policy. What we've seen is that the case counts, as long as they're not leading to hospitalizations, don't tend to change behavior. So consumer behavior so far hasn't changed. If we see a change in consumer behavior because of rising case counts, or if we see an increase in hospitalizations, then that increases the risk of lockdowns. Then I think that starts to affect markets. But otherwise, it's probably not the sort of biggest concern of markets currently.
Wonderful. Caroline Simmons of UBS Global Wealth Management. Really appreciate your time here, guys. We continue to look at equities further to the upside today. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses too for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
Record highs, Guy, for 2021, and it is only November 4th, which means we still have just under 2 months to go. It is a 47.10 on the S&P 500, 24.48 on the Russell. That has you up now almost 2%, trying to close in on some of the highs of the day. All while maybe you had a Fed that was patient on Wednesday, jobs day. That certainly feels like a Goldilocks scenario. You're down 5 and 6 basis points on 5s and 10s, helping to relieve some of the pressure that we've seen in the bond market.
I'm going to turn to Christmas now. I want to know if you've written your Christmas list. Everybody's trying to work out whether Barbie dolls like these, Hot Wheel cars, are they going to make it in time to make it under the Christmas tree? That's the big question. The supply chain story front and center. Mattel CEO joining us next. This is Bloomberg.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I want to be, I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at you'd have to look at what was you're defining as strategic or critical.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that domestically, we're going to have ups and downs for the next year.
We're not immune from the challenges of supply chain.
I think over time, because of the learnings people have had during the pandemic, there is going to be thinking about how do you globalize your supply chain.
These bottlenecks will not go away tomorrow.
The international markets, you're looking at least through February, March, before anything will change. And personally, I think it will go long after that.
There's no objection when it comes to the short and mid-term. We have a fully aligned supply chain when it comes to 2022 and 2023.
I wouldn't be cancelling Christmas just yet. Christmas is definitely happening this year. It just may be happening in a different way across the supply chain.
Christmas is definitely happening this year, Guy. Now, those are various, of course, industry executives on Bloomberg TV discussing the supply crunch. But stop stealing all of the Barbie dolls off the shelf. Leave some for me.
Okay, I'll make sure that happens. We've actually done
Hot Wheels.
Okay, yeah, we've got a big box of Hot Wheels at home, which we built up over many years, I have to say. A lot of people have already done their Christmas shopping. A lot of people are trying to front run
you're
this,
late.
And I think it's
you
interesting.
should have started a month ago.
Yeah, I know. We've got some of it done. We're almost there. But the real question is, are there going to be shortages? Are there going to be issues that you can't get what you want? Ynon Kreiz is the CEO of Mattel, the toy giant, of course, known for Barbie, Fisher-Price, Hot Wheels. You've named some of the names. It's also in the movie business now. Ynon, thank you very much indeed for your time today. The question that I suspect everybody is asking you at the moment, and I'm going to ask it as well, is are people going to get what they want for Christmas this year? Is it all going to arrive on time and be there under the Christmas tree?
Well, we're seeing strong demand for our product. We are ready for a strong Christmas holiday. We have promotional plans in place. We're seeing a lot of activity, and we are ready with our inventory and logistics to put a lot of toys under the trees and have a happy holiday season.
So you said that you do have enough inventory. How have you been navigating the supply chain crisis? Are you big enough that you can pull some levers to make sure that your inventory stays on the shelf?
Yeah, our global commercial organization and commercial operation did a very good job anticipating the short supply and the logistical challenges that we faced. And we factored that into our planning with very specific actions that we put in place. We accelerated procurement of raw material, we expedited production, we contracted capacity and shipping lanes in advance, We secured rates that allowed us to put plans in motion. And with that, we made a lot of progress in advancing our supply and put product on shelves.
Are there any bottlenecks that you're worried about?
It's not that we were not impacted, and of course there are challenges in the marketplace, but with our scale, our flexible model, and all the work that we've done over the last 3 years to create a very productive, very efficient supply chain system, we're able to work through the disruption, collaborate with our retail partners, and put product on shelf and be ready for a happy holiday season.
How much of those disruptions, though, have cost you? Are they impacting your margins, or are you passing costs to the consumer?
Yeah, it did impact our margin. We're also seeing inflation. We raised prices in the third quarter, and we're also taking cost-saving actions to be able to mitigate for inflation. And we expect that over time we'll be able to mitigate the impact of cost inflation.
How much did you raise those prices?
It varies by product and by region. But when we raise prices, we always take consumer in mind and find the balance between quality, safety, and value for consumers.
And how long do you think this is going to last for? Is this something we're going to still be dealing with midway through next year?
It is hard to tell. We entered the fourth quarter with a lot of momentum. We expect that momentum to continue into next year. We just raised guidance for the third time this year for Mattel. We expect 15% growth for the full year, and we expect to continue growing for next year and the one after. We also expect our profitability to continue to improve and exceed $1 billion EBITDA in 2022. So we are seeing growth, we are seeing momentum, and we are ready to manage and work through supply chain disruptions.
Go global for us, if you will. I know within the U.S. there was a lot of concern about consumer demand once the extra stimulus and the government checks had expired. Are you seeing that in the U.S., and how does that compare to the demand that you see on a more regional basis globally?
You know, the toy industry is a growth industry. It's having a lot of momentum. It grew 17% year to date. And when you think about it, the toy industry as a whole is a category where parents will always prioritize, especially when it comes to quality product and trusted brands. And we are seeing the toy industry being resilient, especially in challenging economic times, and we expect demand to continue. And within that environment, at Mattel, we are looking to continue to accelerate our growth and continue to grow our market share with strong demand across multiple categories.
Elon, do you think you are going to see a change in the patterns of demand from children, from parents, once kids start getting vaccinated?
We don't see that. The physical play is here to stay. Toys are in demand. The items are not expensive. And this is something that parents do prioritize. And we are seeing demand across all categories pretty much, and that is expected to continue. The toy industry is also forecasted to continue to grow for the next 5 years, according to Euromonitor, at 5.4% CAGR for the next 5 years. And this was expected before the pandemic. We saw it during the pandemic, and we expect the toy industry to continue growing after the pandemic.
Talk to us about the partnerships that you have with Disney, some of the films, MGM, working with them to create toys to go along with some of those movies as well. How much do you see that as a way to enhance the current business or maybe provide some supplemental income as well?
Well, we work with leading franchises that we don't own. We just announced a partnership with Disney for Lightyear. This is the origin story of Buzz Lightyear, and it's expected to be a big release, a big movie for Disney. And likewise, we also continue to find value in commercializing our own catalog. We own one of the strongest offering of children and family entertainment franchises in the world. And the opportunity that we see is to extend our toy business beyond the toy aisle into highly accretive business verticals. Think film, television, live events, consumer product and merchandise, online games, music, all big categories that are driven by big franchises. And this is where our scale and quality product come into play. We've announced 13 movies that are in development right now. We released 8 new television series already this year, and have many more in production, and expect to continue to find ways to engage consumers on multiple levels in addition to what we do on the toy side.
To infinity and beyond. Ynon Kreiz, Mattel CEO, thank you very much indeed.
Guy, I expect a Barbie doll for Christmas. You can ship it here.
Okay, I would have thought you'd already have that covered. You sound like an organised person. I would have thought, as you say, you've already have your Christmas shopping done.
No, this is for you to get for me, my present.
Oh, right, sorry.
From you.
Okay. Well, when I get on Monday, I'm going to be allowed to come over and see you in New York. So maybe I'll bring it with me. What are we going to talk? Talking of travel, we're going to talk more about travel next. Uber's ride to recovery. Dara Khosrowshahi is going to be joining us next. Really looking forward to this conversation. Emily Chang's going to join us. That's next. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year. Yeah. And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
Gasoline prices are high because it's mixed with ethanol that went tenfold. Gasoline prices are high because there is low stocks in the U.S.
Uber shares are 4.3% as we speak. This after the company reported its first ever adjusted profit. First number we've seen in the positive category since the firm went public. Joining us now to talk about this huge milestone for the company, Dara Khosrowshahi, Uber's CEO. And of course, I'm joined as well by Bloomberg technology anchor, Emily Chang. Emily, over to you.
Guy, thank you, Dara. Thank you so much for joining us. Obviously, huge milestone for you. As Guy said, $8 million in adjusted EBITDA profit. Is this something investors should get used to quarter after quarter? How confident are you Uber will continue to be profitable?
Oh, we're quite confident. And actually, in the indications guidance we gave for investors for Q4, we got it to $25 to $75 million in EBITDA profitability. And I think for the foreseeable future, you can expect to see a company that is growing our top line at a very healthy rate, over 20%, as we expand into this $5 trillion mobility total addressable market, as we expand into the delivery $5 trillion total addressable market, and freight as well, while improving the profitability of the business. We're really hitting that scale point globally where we can deliver both growth and profits for the foreseeable future.
Now, I know you've been working on driver supply, but wait times are still longer than usual and fares are still higher than usual. How much longer will wait times and fares be elevated?
Well, we've added, even just in the U.S. alone, 640,000 drivers and couriers to the platform. Number of drivers on the platform is up 65% since January. Number of couriers on the platform is up 80% since January. And the good news is that the incidents of surge pricing are about half of where they were at their peak. Average wait times are about 4.5 minutes, so we're below that magic 5-minute mark. Not everywhere, but on average. So the quality of the service continues to get better. You know, the problem that we have is we have too much demand as everything is opening up. Now we're seeing travelers go to airports as well. Airport trips are up 20% just in the past 2 months, and for business travel are up 60%. So there's a ton of demand out there, and we are catching up to demand happily, but the demand keeps growing ahead of us as well.
And at the same time, there is a huge labor shortage, inflation. We're heading into the holidays when companies like Amazon are sweetening the deal for holiday workers. Lyft co-founder John Zimmer told me earlier this week he's not interested in getting into a price war. He's focusing on differentiating the product to win these drivers over. How big a challenge is it going to be to continue to keep drivers involved through the holidays, and what's your strategy?
So I think the great news on drivers is that driver earnings, first of all, are at historical highs. If you're a driver who is driving more than 20 hours on the platform, so you're a pretty engaged driver in a top 20 market, you're making, including tips, $40 per active hour. So the earnings are very high. And then within this world, you know, the Zoom world of ours, where we talk about flexibility and being able to work whenever you want, wherever you want, et cetera, that's exactly what Uber offers for blue-collar work, call it. And you can choose to move people, or you can choose to move food around as well. So we have the broadest platform than anyone else. So we think the combination of earnings opportunities, which are dynamite, and flexibility, whether you want to drive people or drive things, puts us in a really good position. And you can see it in the trends in terms of drivers on the platform being up and couriers on the platform being up. And we only see those trends improving as we get into Q4 and, frankly, into next year.
Dara, good morning. It's Guy. Let me just talk a little bit about what's happening over on my side of the pond, which is London. London's traditionally been, from my perspective, a pretty hot market for Uber, but competition has increased massively over the last couple of years. Emily highlighting the profitability and the milestone that you guys have achieved. Is London profitable on an adjusted basis as well? I'm curious to see what the profitability numbers look like over here.
So we don't disclose profitability by city, et cetera. I will say that in London, we have passed a great milestone of declaring drivers as workers. That means they've got the flexibility to be on the platform as well, but they essentially earn a minimum wage, they earn pension benefits, et cetera, which we think are terrific. We're now working with the GMB to make sure that the driver worker experience is absolutely top notch. Many of our competition have not moved forward and have not done the right thing. So they enjoy a pricing advantage, you know, kind of taking advantage of drivers out there. This is the UK Supreme Court declared that drivers should be workers. So we have followed suit. We think right now some of the competition has a pricing advantage, but it's based on what we think not following the law. And we think the will of the Supreme Court should be recognized by anyone in the transportation industry. We think it will happen. When it happens, the UK market will be a great market for us, and it'll be a great market where drivers are using our platform in the right way, which is as workers.
Darren, the big conversation right now is about supply chains and bottlenecks. You are moving more and more into the freight business. You've done the Transplace acquisition. That was, back in July. What do you think is happening in the global supply chain story right now? What do you make of it? How sustainable is the current situation? What needs to happen to fix it?
Well, I think what needs to happen is investment going into the global supply chain. We saw an opportunity in that the supply chain was a part of the global logistics ecosystem that was taken for granted. It was underinvested in. Technology hadn't entered into the supply chain. And with Uber Freight, we are now using technology to connect shippers with carriers on a direct basis. What we're seeing is that independent truck driver is quitting from fleets and actually now joining Uber Freight as an independent contractor. They can make more money, they've got more freedom, and that independent contractor can use the freight system to deliver for Coca-Cola, to deliver for incredibly big brands, because we make sure that the quality is there, we track everything, we use technology to really revolutionize the logistics ecosystem. So we think it's a great opportunity. Our freight business is at record highs, and we think we can be part of the solution going forward.
Dara, you've got another big and growing business. You said the core restaurant and food delivery business is profitable. Lyft, though, saying they're seeing drivers going from delivery into food, wondering if you're worried about delivery driver shortages, and also with DoorDash gobbling up more market share, how do you get a bigger piece of that pie?
So I think the great news for us as far as market share was in Q3 in the U.S., we not only increased profitability, but we gained share in the marketplace. So we are the market share gainer in the overall marketplace in Q3 in the U.S. And we're neutral. We essentially now offer a driver who signs up to drive on Uber. You can deliver food, you can you can drive people. And by the way, you don't need to choose up front. We'll give you both opportunities. And based on how much you can make, where you want to go, where you want to work, when you want to work, you can choose to do either. We think that's a superior solution. No one else has that solution. And we think ultimately, if you really help the customer, in this case, the customer as a driver, decide how they want to earn, you will win over the long term because you will become the preferred platform. I think you're seeing that now in the growth in drivers, 65% since January, and the growth in couriers, 80% through January. More and more choosing our platform because it's the broadest one and it's the most flexible one out there.
Darren, it's great to see you today. We really appreciate your time. Thanks for sharing some of it with us here at Bloomberg. Darren Khosrowshahi, the Uber CEO. Great to see you. Emily, thanks very much indeed. This is Bloomberg.
Energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Alex Steele may not be here, but we should probably still talk about what is happening in the energy markets. The president apparently, quote, looking at a potential release from the Strategic Petroleum Reserve. This, of course, after OPEC rejected a request from the president for a larger output increase from the cartel. The U.S. Energy Secretary, Jennifer Granholm, speaking about energy prices and the U.S. administration's plans from COP26 in Glasgow.
As you know, of course, oil is a global market. It is controlled by a cartel. That cartel is called OPEC, and they made a decision yesterday that they were not going to increase beyond what they were already planning. So, the interesting thing is, the Department of Energy has an energy information agency, and that agency does the forecasting of what oil and gas prices are going to be. As of right now, their forecast for the beginning of December is that on average gasoline prices will be about $3.05 at the beginning of December. They will do an adjustment to that forecast in the next week or so we'll see if that holds. Mm-hmm. But clearly the Biden administration is very concerned about the price at the pump and certainly the price in people's wallets for natural gas as well for this winter, including, I would say, propane and heating oil, particularly in the Northeast.
Let's pick up with the words of the Pioneer CEO. The president's efforts to restrict drilling on federal land and offshore have been starting to backfire some. His quote, he's got to back off his rhetoric on federal leases going forward. Do you think it's true that we are reliant on OPEC Plus in the United States of America?
We are reliant on a global gas market. I mean, the global gas market, we can't just produce oil for the United States. It is on a global market. And let me just say, the president has not banned oil and gas leases. There are 23 million acres of public lands, that includes offshore and onshore, where there are leases that are not being used right now by oil and gas companies. Over 7,000 leases have been issued, and the oil and gas companies are not using them. They're sitting on them. They're stockpiling these leases. Why is that? So we need, if the production issue is not at the foot of the president, there is not a ban on oil and gas leases on federal lands.
Madam Secretary, when can we expect a decision with the SPR? Is that something you're thinking about imminently?
I know that the president is looking at it, and he'll have more to say about it.
That was U.S. Energy Secretary Jennifer Granholm speaking, of course, to Bloomberg from COP26. Guys, certainly an interesting few hours it has been coming off of the jobs report, pushing forward to next week where we're going to get PPI, CPI as well. But still more to come on this program because Betsy Stevenson, University of Michigan Associate Professor, joins Balance of Power with David Weston here on Bloomberg Television and Radio.
Talking of radio, I'm going to go to radio very shortly. We'll be doing that at 5 p.m. The cable show. We'll work our way through day 2, I think, actually, of the Bank of England story. But, of course, the main focus, what is happening with the fallout from that payroll report. It's on DAB Digital Radio. Taylor, thank you very much. Have a great weekend. This is Bloomberg.
проходим опасный участок, ответственный. Рустам поднимает тебя на жумаре. Шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца как бы внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком я хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
$111 million people use Twitter every day all around the world. 20% of those are in the United States. The top of funnel is really healthy. So we get a lot of at-bats, and we just need to keep doing a better and better job of converting people to help them make Twitter part of their daily ritual.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome to Balance of Power. The big news of the morning were those U.S. jobs numbers. And for a perspective from the White House, we welcome now Dr. Jared Bernstein. He's a member of the Council of Economic Advisors. So, Jared, you beat across the board, I think it's fair to say, both in terms of last month, but also the revisions for the prior month. Give us your perspective on exactly why we have such robust job growth, at least right now.
I think the president's plan is quite clearly working in the American job market. People have more job opportunities than they've ever had before. We know we're at a record number of job openings and well over 500,000 jobs created in October. If you take the average, and this is important to us, David, you know, in good months and bad months, we've come out here and said we're not going to focus just on 1 month because these high frequency data can be noisy. So we average out. And if you look at the average monthly job gain since the president's got here, it's over 600,000 jobs per month, an historical record, 5.6 million jobs on record. The unemployment rate down to 4.6%, falling faster than almost any time in the history of these data. So this is a robust job market offering solid job opportunities to all comers.
So let's not take a look just at 1 month, as you suggest, but a longer-term trend, specifically on participation rates, because looking at those participation rates, they have not come back to where they were before. They came back some, but they seem to have stalled out right now. Why is that?
Well, there are a number of, this is kind of a Murder on the Orient Express, not to be a spoiler of the movie, you know, the number of potential factors in play here. Certainly, even as COVID caseload comes down, people tell us they're concerned about COVID, and that's keeping some folk from the workforce. Care arrangements continue to be a challenge for people. And by the way, that is just so clearly connected to the president's Build Back Better agenda. Accessible, affordable child care. Now, a report came out this week from Moody's.com estimating that the increase in the labor force participation rate would be driven by the introduction of accessible and affordable child care. That's part of the answer, too. I do want to say one thing, though, that I think people forget. There is a long-term trend in the labor force participation rate of negative about 20-25 basis points a year. So if you just sort of factor out the bips and bops, the long-term trend, because of the aging of the labor force, is is down about, a fifth of a percentage point per year. Now we see that strong job markets tend to get you above that trend, and we expect that to happen in coming months. But it's also important to look at the age of the labor force in this regard.
Well, it's interesting though, Jared, if there is that long-term trend, I'm sure that there is, and it's nobody's fault, certainly not mine, not yours, might have some effect though on wages, because we saw the wages bump up. We're now 4.9%, right, growth year over year numbers. And if in fact we have a structural reduction in the participation rate, doesn't that mean that we're going to have a structural increase in wages?
Well, certainly there's a supply-demand story that's playing out as we speak, and you can see that, for example, in leisure and hospitality and other low-wage sectors. Wages for low-wage workers are actually beating inflation, and by a decent clip in some of these sectors. So absolutely, we have to put it in wonky economic terms, there is a wage Phillips curve that is a positive relationship between, or I should say a negative relationship between falling unemployment and strong wage growth, and that is in the mix. The labor supply plays a role in there as well. But again, it's a very dynamic story because strong wage gains tend to pull people into the labor market. And that is something we and every other forecaster expects to see in coming months.
But Jared, as you know well, part of the reason why markets and investors pay attention to that wage number is in part because of that dreaded wage price spiral and the concern that inflation might get ahead of us. Why should we not be concerned about that right now?
Well, because really the wage and the price dynamics seem to be concentrated in a couple of sectors. It's not nearly an economy-wide thing, part one. Part two is it is widely agreed upon. You heard this, I think, very clearly from Jay Powell this week, that the inflation story is very much a pandemic-related supply chain snarl story. That is, we have our supply chains constrained by pandemic-related problems in some key logistical areas. As those sectors normalize, we expect the supply chain to unsnarl, inflation to decelerate, and that, again, is by far the modal forecast. Every forecast I've seen has inflation growing considerably slower by the second half of next year. But, and this is key to your question, those same forecasts have the unemployment rate continuing to come down and wage growth continuing to be strong. So this dynamic where low unemployment pushing up strong wage gains, normalization inflation translates into real wage gains as that situation unfolds.
But Jared, does that mean, if I'm listening to you correctly, does that mean that, frankly, the thing that should protect us against inflation getting out of control is actually fixing the supply chain more than it is monetary policy? Because I do note that when the Federal Reserve had their meeting this week and Jay Powell came out and gave his remarks, financial conditions actually loosened. They didn't tighten. So that tapering that they started doesn't seem to be affecting, actually, the financial conditions.
Well, I would actually even go back one step and say that the key thing here is really the virus and the president's vaccination program. I mean, one of the things I looked at this week was the relationship between GDP growth and just virus caseloads. And it is just so clear. When the virus caseloads were falling in the first half of this year, GDP was growing at an annualized rate of 6.5%. That's gangbuster. You saw the Delta variant pick up and you saw GDP decelerate in the third quarter. Now in the fourth quarter, with Delta caseloads down, COVID caseloads down related to Delta, 60% off of their peak. We're seeing forecasts between 4.5% and 5.5% for Q4. So really the key factor here, both for the economy, which has been highly elastic to movements in the caseloads, and for the supply chains, and for inflation, and for so many other variables, is vaccination and keeping control of the virus. And that is something that the president's been committed to since he took office.
So, Jared, finally, you mentioned Build Back Better and why it could be really important from your point of view on the participation rate. The president mentioned it as well when he gave his remarks. He also said he was going to go back to the Oval Office and make some calls on getting Build Back Better done. I believe now he's moved on to Colin Powell's funeral, which is taking place right now in the Capitol. I know you're not the legislative affairs guy, you're the economics guy, but you must hear things around the White House. Are you going to get it done?
You know, first of all, when it comes to the timing of the votes, that's something that we've consistently left to leadership. Pelosi, Schumer, these folks are playing a very tight schedule over there, and we talk to them about that. From our perspective, it is just essentially important to get this passed, to move this forward as quickly as possible. And this president just continues to pull legislative rabbits out of hats. I've stood here with folks, not you, but folks telling me, this couldn't happen, it's not going to happen, it's not going to get this far, he can't get over this hurdle, and he continues to get over the hurdles with help from Democratic leadership. So we look forward to seeing that evolve as the day goes on.
Okay, thank you very much. As the day goes on, that was a little bit of a hint, maybe. Thank you so much to Jared Bernstein. He's a member of the White House Council of Economic Advisors. Coming up, we go to Capitol Hill and a member of the House Democratic leadership, Representative Dan Kildee of Michigan. This is Balance of Power on Bloomberg Television and Radio.
Hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Congress is back at it today, trying to deliver on Speaker Pelosi's promise to get to the votes on the House on both the bipartisan infrastructure bill and the president's Build Back Better plan. Welcome now a member of the Democratic House leadership. He's Congressman Dan Kildee of Michigan. So, Congressman, thank you so much for being with us. But before we get into this very important subject of Build Back Better, I want to take a moment to talk about your uncle, Dale Kildee, who passed away, and he had your district for a good long time.
He did. He represented this district, or different forms of it, for 36 years. I spoke at his funeral yesterday, and the thing that I think was most remarkable about him is how kind and gentle, how dignified he was for all that time here. And I only say that because if there's a legacy that this place needs to pay attention to right now, it's that part of his legacy. We need to all treat one another better, not just because it's easier to get things done that way, but because it's the right thing. And I think too many people around here have missed that message lately.
I'm sure that's right. We heard Speaker Pelosi actually pay homage to your late uncle a couple of days ago. So let's turn now to this question of Build Back Better and what's going on up on Capitol Hill right now. When are we going to get to a vote?
Well, we hope today. I mean, we're working it. There are some members who still have some technical issues, and many of them are getting resolved. We have agreement on the broad framework of this. I do think we have some that are being more difficult, to be frank, but we're getting through that. And the hope is we get to a point with this really thin margin that sometime today we're going to be able to pass the bipartisan infrastructure bill, which is critical, and the Build Back Better legislation, both of which are long-term investments that will help us build on some of the recent good economic news that you were just talking about with Mr. Bernstein. So I think this is an important time.
So obviously the President of the United States, Joe Biden, is working very hard on this. At the moment, he's at the funeral of Colin Powell, but he said earlier today he was going to be going to the Oval Office to make some calls. This is what he had to say earlier about how he's calling on every single member of Congress to vote yes.
I'm asking every House member of the House of Representatives to vote yes on both these bills right now. Send the infrastructure bill to my desk. Send the Build Back Better bill to the Senate. Let's build an incredible economic progress. Build on what we've already done, because this will be such a boost when it occurs.
So, Congressman, you're one of those representatives that the President has been calling upon. Give us your sense, both as a member of the House, but also as a member of leadership on the Democratic side. How effective is the President's lobbying, if I can call it that right now?
It's been helpful. I mean, the fact that we've now gotten to this point is largely due to the President's involvement. This is his agenda. It's one that he articulated on the campaign trail and that we all aligned ourselves with. And so, while the Build Back Better legislation doesn't have everything that I would like, just like other members, I have to look at the big picture. And I think that's what the President's asking some of these members to do, to understand that, we don't get to prescribe every piece of punctuation in these bills. It's compromise. And if we aren't willing to compromise, it's hard for us to ask our Senate colleagues to do the same thing. If we're willing to make some compromises, push through legislation that broadly represents the values that we all committed to our voters to implement, and then we work to try to make whatever changes we can to get it through the Senate, I think that's really what we're called to do. Too many people here take the position that it's their way or the highway. And actually, if they have their highway or their way, they won't have a highway. We're not going to get anything done.
Talk to us about how much it'll cost them, how we'll pay for it. I mean, I know what's terribly important is what it does, but also we do have to look at the numbers. I saw some reporting coming out of Capitol Hill today that actually there has to be a CBO scoring of this before really there can be a vote, and that might take some days.
There does have to be a CBO score before the legislation can become final. We have our estimates that we've been working on for really weeks and months now that we can depend upon, I think, largely. But as we make some changes, there has to be a new CBO score before the Senate takes final action. I think it is important to point out to some of my colleagues that the Build Back Better Act is fashioned in a way that it's paid for. Some of the elements within the bipartisan infrastructure bill depend on the promise of economic growth, which I agree with, by the way. But I think it is somewhat disingenuous for some of our colleagues to imply that without the CBO score, we somehow can't take the next step in the process when the entire structure of the Build Back Better Act depends on us offsetting the expenditures with new revenue. That's hard to do, and it's painful, but we did it, and that ought to be recognized.
Congressman Kildee, it's been quite a week. We had a big election in several states on Tuesday, and the Democrats, I think it's fair to say, did not do particularly well, particularly in Virginia, where they lost the gubernatorial race. They almost lost in New Jersey as well. What did you make of that, and what effect does that have on Build Back Better? Does it make it more likely to get done or less likely to get done?
I think it makes it more likely. And look, those election results were disappointing. To be fair, they weren't completely out of sync with historical trends, but nonetheless, they were disappointing. We wish we had prevailed. I think it makes it more critical, more clear, that we have to get out of our own way, some of us, and move our agenda forward. That's what the American people want. That's what they're looking for. They don't really care about the sport of the politics of all of this, or the Washington speak that we hear around this town so much. They care about the things that matter on their kitchen table. And that's what we have constructed with the Build Back Better Act and with the bipartisan infrastructure bill. Initiatives that will affect their daily lives in a positive way. There's nothing more eloquent than a message that lands on the kitchen table.
So let's talk about the kitchen table, and let's just pick one at random in Flint, Michigan, someplace you come from, I come from. At least I knew that part of the world pretty well at one point. What is it that they want around the kitchen table in Flint, Michigan? Because there's some suggestion that the Democrats have gotten a little far away from that, particularly in Virginia, for example. They were talking about some things that didn't matter that much on the kitchen table. There was more things like critical race theory and defunding the police and things. Does that resonate in Flint?
Yeah, those issues don't resonate in Flint. What resonates in Flint is anything that has to do with taking care of their kids, making sure they have enough food on the table, making sure that they can pay for the cost of medicine and health care, making sure that there's a job for mom and dad that they can go to without having to wonder where they're going to have their kids while they're at work. I mean, this is why the elements of the Build Back Better Act, when presented to the American people, are so popular. But the politics that have surrounded all of this make it difficult for people to see themselves in that conversation. And that's on us. That's on us. We have to do a better job of making it clear what it is we're actually working on and not let some of these distractions take us away from the central issue, building an economy that allows people to be the best they can be, to have their kids go to a good preschool and daycare so they can contribute to the economy, make a good wage, have a good life. That's what 99% of Americans think about. The other 1% are talking about the politics every day, not the people I represent.
So let's talk specifically. It sounds like one of the things that would appeal to people in Flint are things like child care support. That would help them a fair amount. Preschool, quite possibly, to have their kids going to someplace for preschool. What about charging stations for electric vehicles? What about some of the alternative energy things? Does that resonate with people in Flint?
It does. I think when they look at their own futures and realize that since we are really moving to electrification, since that's going to be the future of mobility and certainly of the auto industry, if we want to have our part of that auto industry, manufacturing those electric vehicles, we have to have policy that helps get us there. So when we take the time to explain how this connects to us owning our own future, rather than being consumers of foreign-made vehicles, as we've seen in the past, then I think they understand how that does translate, for sure.
So let's assume for the moment, and I think it's an assumption at this point, that you do get the infrastructure bill passed and you get some trimmed down version of Build Back Better that we, I think, kind of understand the contours of right now. What does that do for you in the midterms? How does it do for other Democrats?
Well, what it does is probably the most important thing, because the people, as we talk about the people I represent back home, what they want to hear from me is not what my plans are, what my hopes are, what my aspirations are, what my talking points are. They want to know, what have you done that will affect my life in a positive way? And that Build Back Better Act and this long-term commitment to infrastructure is something that we can explain that we have done, that will be good for this country and for those families.
One last quick one, if I can, Congressman, and that's SALT, the state and local tax deduction issue. It's a big issue in New York, New Jersey, Connecticut. Does it play at all in Flint? I have a tough time imagining that they are really very stirred up about this.
Not so much in Flint. I mean, there are parts of Michigan where the SALT tax benefit is of concern. But it does obviously affect those really higher income areas of the country more dramatically. It's a real issue, and it's one that, obviously we think there's a reason to address. I think what we're trying to come up with now is a reasonable set of caps so that the vast majority of people who are middle income earners who really do pay the price for the lack of this benefit can get some relief.
Okay, Congressman, always a pleasure to have you with us. And once again, we really are sorry for your loss of your uncle, Dale Kildee. That's Congressman Dan Kildee. He's a Democrat of Michigan. A programming note, Wall Street Week airs tonight at 6 p.m. Eastern Time. I'll be joined by Larry Summers, Ken Jacobs of Lazard, former BOE Governor Mark Carney, and Afsani Beshlas of Rock Creek. This is Balance of Power on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Supply chain team's done a great job on semiconductors. We've been able to secure semiconductors for our entire business globally and been able to keep all of our installations globally, which we do almost 10,000 every day somewhere in the world, all on track.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Energy Secretary Jennifer Granholm spoke earlier today to Bloomberg about administration plans to address higher gas prices and the possible use of the Strategic Petroleum Reserve.
As you know, of course, oil is a global market. It is controlled by a cartel. That cartel is called OPEC, and they made a decision yesterday that they were not going to increase beyond what they were already planning. So, the interesting thing is, the Department of Energy has an energy information agency, and that agency does the forecasting of what oil and gas prices are going to be. As of right now, their forecast for the beginning of December is that on average gasoline prices will be about $3.05 at the beginning of December. They will do an adjustment to that forecast in the next week or so we'll see if that holds. Mm-hmm. But clearly the Biden administration is very concerned about the price at the pump and certainly the price in people's wallets for natural gas as well for this winter, including, I would say, propane and heating oil, particularly in the Northeast.
Let's pick up with the words of the Pioneer CEO. The president's efforts to restrict drilling on federal land and offshore have been starting to backfire some. His quote, he's got to back off his rhetoric on federal leases going forward. Do you think it's true that we are reliant on OPEC Plus in the United States of America?
We are reliant on a global gas market. I mean, the global gas market, we can't just produce oil for the United States. It is on a global market. And let me just say, the president has not banned oil and gas leases. There are 23 million acres of public lands, that includes offshore and onshore, where there are leases that are not being used right now by oil and gas companies. Over 7,000 leases have been issued, and the oil and gas companies are not using them. They're sitting on them. They're stockpiling these leases. Why is that? So we need, if the production issue is not at the foot of the president, there is not a ban on oil and gas leases on federal lands.
Madam Secretary, when can we expect a decision with the SPR? Is that something you're thinking about imminently?
I know that the president is looking at it, and he'll have more to say about it.
That was Energy Secretary Jennifer Granholm speaking to Bloomberg earlier today. Coming up, we're going to go over those strong U.S. jobs numbers with economics professor Betsy Stevenson of the University of Michigan. They came in surprisingly high, not just for this last month, but for revised numbers for the month before. Why did it happen? And what about the participation rate that seems to be flattening out? This is Balance of Power on Bloomberg Television and on Bloomberg Radio.
Hong Kong lost its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now into weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Balance of Power on Bloomberg Television and Radio. I'm Guy Johnson in London. We're wrapping up the European equity session. The week almost over. Next few minutes of an auction will give us the final numbers, but I can give you a flavour of what is happening right now. Broadly positive. It's been a positive story. The last couple of days have really kind of cemented that. It has been a decent volume day here in Europe as well. Clearly a reaction to the payroll numbers, which David's going to be talking about in more detail in just a moment. But nevertheless, the corporate narrative continues as well, so we've got to factor that in. But the FTSE 100 up by 0.3%. The CAC 40 in Paris up by 0.6%. The outlier is actually the German market, the DAX, absolutely flat on the day, but broadly over the week they've all been positive. In fact, let's talk about what we've looked like this week. I can give you an idea. The Stock 600 has hit a series of record highs. You can see some of it there. This is the beginning of the week. That's the first, second and the third. Can't quite make out the rest of the week, but nevertheless we find ourselves in a situation where I can tell you that it's been a week where the Stock 600 has gained around, there it is, 1.63%. We're up at 483. Fresh records being taken out. The real story came in kind of Wednesday into Thursday. We saw that big sort of gap higher that morning. We've continued in that sort of more elevated range into the 480s. Really impressive performance being generated by these equities as we continue to see volatility elsewhere, particularly in the rates market, particularly in the UK. Quick look at the GRR, just to give you a sector breakdown. Consumer stocks really the main drivers here. We've seen luxury stocks, in fact, being the driver this week. In fact, the consumer sector has been the driver for the week for European markets. Travel and leisure's done well, alsos have done well. Healthcare actually underperforming. Why is healthcare underperforming? All the vaccine makers have had a really tough day today on the back of that news out of Pfizer that it's got this new pill which has 89% efficacy in keeping people out of hospital. So that means actually less of a focus on the vaccine makers, more on the therapy story. And you can see that with AstraZeneca down by 1.44% there in the middle. IAG, interesting, bouncing back actually midway through the day, which was fascinating. Initially, the market actually took IAG, which is the owner of British Airways and Iberia, down quite sharply firstly this morning. The reason for that, the full year projected loss bigger than anticipated. However, David, Monday, a huge day. We resumed two-way traffic across the Atlantic. You've been able to come and see us over here in Europe for quite some time. As of Monday morning, the US borders reopened so people can get on planes if you are European citizens and fly over to the United States, assuming you've got all the paperwork in order. Anyway, IAG up by 5.43%. I'm going to be talking to the CEO of IAG come Monday morning as well on that huge day, the resumption of two-way traffic on the North Atlantic. AXA, I've just thrown this in here actually. It's come off over the last few minutes, but again, another company just dishing out huge amounts of money, huge buyback program announced. It's becoming a really regular theme at the moment, and many analysts are expecting it to continue. So the buyback story really front and center once again. David, back to you.
Guy Johnson, thank you so much. It's been great having you this week. And by the way, after you interview the CEO of IAG, then you should hop on one of those British Airways planes and come visit us over here, Guy. Okay, we want to turn back to those jobs numbers Guy talked about. They came in surprisingly strong in the United States today for the last month, but also for revisions from the prior month. For her analysis of what we learned, we welcome now Betsy Stevenson. She's professor of public policy and economics at the University of Michigan. Dr. Stevenson earlier served as the chief economist for the Department of Labor in Washington. So, Dr. Stevenson, thank you so much for being with us. What do you make of these numbers? They did surprise to the upside.
Well, honestly, I didn't find them to be that surprising. What we saw is that, since the pandemic started, is the virus really drives the economy. And what we saw in August and September was the Delta variant was surging, and we saw employment growth really slow because of it. And we saw the Delta variant start to recede, case counts receded. You go back to the week, the reference week, right? They look at the week that includes the 12th of the month in September. And that week we were having 200,000 cases a day. Now you fast forward 4 weeks to October, we were down around 90,000 cases a day. So we knew we were going to do better. You could also look at data that said, how do consumers feel about doing in-person activity? They were feeling more comfortable, a lot more comfortable by October than they had felt in September. In September, they felt a lot worse than they had it in July. And you can see this by taking a look at what happened in the service sector. We had over 600,000 jobs were added in the private sector. Remember, the government right now is subtracting from our jobs. So, we lost 73,000 jobs in government in October. We'd lost 53,000 jobs in government in September. But the service sector, we saw almost 500,000 jobs added this month. Not quite double the pace of the previous month, but nearly. So it's that people being willing to get back out there and take the job, and also being actually willing to stimulate demand by getting out to restaurants and other in-person activities.
So, Betsy, one of the side effects, I think, of the pandemic is we haven't had numbers we could rely upon because they've been all over the place, way up, way down, way down, way up. Are we getting to close to a place with the labor market where we can start to rely on it? Because, as you said, we had the COVID situation, which was very fluid. We also had the supplemental unemployment benefits that now have largely come off. Are we getting close to a place where we think, yes, that is an accurate picture of where we are?
Well, I mean, look, every snapshot of data is just one piece of a puzzle. And, if you're a smart analyst and you're trying to figure out what's actually happening for real in the labor market, you want to put together, more than one piece of data. I look at, not just the unemployment rate when it comes to the household survey, but how many people were captured as employed in the household survey. I know, dig a little bit deeper into the establishment survey, put that together with, what we also see in those, new layoffs through initial unemployment insurance claims. But I think that what's not happening anymore is people aren't confused about whether they have a job. And in the early days of the pandemic, people didn't know whether to report themselves as employed or unemployed. And that led to a lot of chaos. I do want to just comment on the revisions because I wondered if your question was coming from that. It's not unusual to see upward revisions in a recovery. In fact, that's what we see in almost every recovery. It'd be great if we didn't have systematic revisions. But when we're going into a recession, we tend to see revisions systematically downwards. When we're coming out of a recession, they tend to be systematically upward. Now, that's just sort of the way it goes because it can be really hard to know about new businesses that, are just being started today.
So, Professor, I wonder if there was a yellow light, at least in these numbers, in the participation numbers, which seem to have flattened out now. We're not getting back to where we were before, particularly when you put it together with a 4.9% year-over-year increase in the wages. If, in fact, we've taken that number of people out of the workplace permanently, more or less, does that really put wage pressure in place?
So let's break this down a little bit. I don't think that it's just flattened out. Look, we are in terms of participation, we're at the same place we were exactly a year ago. So what we haven't seen is a real recovery in the participation rate. In every recession, the participation rate gets hit. Not only does unemployment go up, but participation goes down. Participation comes back more slowly. So we do need to do more to get more people back into the labor market, but we also need to understand that that's why the Fed keeps saying we need to be patient. We need to give time for a full recovery in the labor market. because the thing that is the slowest to recover is that participation rate. And let me tell you a secret. It doesn't just happen by pulling new people into the labor market. It happens by preventing the exits. Every single day, lots and lots of people enter the labor market and lots of people exit it. If we want to build labor force participation, one way to do that is slow the exit rate. And that's what happens in a tight labor market.
Okay, so this is just an anecdote, one piece of data, but I'm curious to see whether you think it may indicate something broader. And I want to talk about Deere and the UAW negotiation, where they went on strike, negotiated a contract that looked pretty robust to me, and rejected it. Are we seeing the first indications of increased bargaining power on the part of labor?
I don't know. It's the first indications. I think that's what we've been seeing for the last 3 or 4 months. And, it absolutely, it feels to me like the whole country is coming together to bargain with employers and say, I want something a little bit better. This, keep in mind, this is happening after 2 decades of a decline in the labor share of income. So the share going to workers has been getting smaller and smaller and smaller each year. This year, people are standing up and saying, this decline in our share, we don't like it so much anymore. We want more. I think that's going to put some pressure on profits. I don't know that this is necessarily going to put pressure on prices. I think we've got to reckon with how much is going to workers and how much is going to investors.
Well, that's the interesting question, isn't it? Whether it does put pressure just on margins, profit margins, as opposed to prices. How will you be able to tell that? How you keep from infiltrating itself into prices and leading to inflation? It might be hard to get under control.
I'm going to just echo Chairman Powell and say, right now we don't see any evidence of any kind of wage price spiral. What I see out there is people are changing jobs and changing industries. That's where people tend to get a lot of their raises, their lifetime raises, is when they make that kind of change. When you hire that person, that brand new person, often that's when they're capturing what economists would call the greatest share of the surplus. You hire them because they're going to produce more for you. It's worth it to hire them, but they're getting a big chunk of it. As they stick around with you for a while, maybe you don't give them that competitive raise. And it's only when they find some other employer that's like, hey, actually, you really would produce a lot for me. And you get that outside offer that gives you that higher raise. So I think right now what we're seeing is a little bit of compression. Obviously, that could turn, but, I would just say that I see more anxiety today about wage increases because they're happening at the bottom, when we've seen a lot of upward wage pressure on college graduates, executives, CEOs, for some time without people wringing their hands about whether that's going to cause a wage price spiral.
That's a really interesting point. Thank you for making it. It's always good to have you with us. That's Professor Betsy Stevenson of the University of Michigan. Coming up, big news on the possible pill to fight COVID. We talk with Dr. Amber D'Souza of Johns Hopkins. This is Balance of Power on Bloomberg Television and Radio.
хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Это не просто вот чем дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. То есть второй будет проще.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Ritika Gupta.
Thanks, David. Friends, family and former colleagues are honoring Colin Powell, the widely praised soldier diplomat who rose from humble Bronx beginnings to become the first black chairman of the Joint Chiefs of Staff and later served as the first black Secretary of State. Powell is being remembered at a funeral today at the Washington National Cathedral. President Biden and the First Lady are attending. And President Biden is considering a potential release from the Strategic Petroleum Reserve to bring down those gasoline prices after OPEC Plus rejected his request to increase crude production faster. That's according to Energy Secretary Jennifer Granholm, who told Bloomberg Television today the Biden administration is, quote, very concerned about the price at the pump.
On average, gasoline prices will be about $3.05 at the beginning of December. They will do an adjustment to that forecast in the next week or so, so we'll see if that holds. Mm-hmm. But clearly, the Biden administration is very concerned about the price at the pump and certainly the price in people's wallets for natural gas as well for this winter, including, I would say, propane and heating oil, particularly in the Northeast.
OPEC and its allies ignored the pleas of its customers and stuck to its plan for the gradual monthly oil output increases of 400,000 barrels a day. Major consumers say that's not enough to sustain the post-COVID economic recovery. And the US and China are not considering reopening shuttered consulates in each country, the White House says. The statement from the US National Security Council comes after a report said the move was under consideration as part of an upcoming virtual meeting between President Biden and Chinese leader Xi Jinping. That meeting is said to be part of, quote, ongoing efforts to responsibly manage the competition between our countries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. David.
Thank you so much, Ritika. Pfizer announced today that its COVID-19 pill reduces hospitalizations and deaths for high-risk patients by some 89%, sending the stock up and raising hopes for a ready treatment people would be able to take at home. To explain what this could mean, we welcome now Dr. Amber D'Souza. She's professor of epidemiology at Johns Hopkins Bloomberg School of Public Health, a school supported by Michael Bloomberg, the founder and majority owner of our parent company. So, Doctor, thank you so much for being with us. Give us your take on how significant this development potentially is.
This is an exciting development. We know that prevention with the vaccine is our best hope against the pandemic, but that infections can still spread even when you're vaccinated, and there are many people who haven't had access to the vaccine yet. So having a treatment to severely reduce illness and hospitalization and death among people with COVID is a bit of a game changer in helping us bring down mortality.
So as I understand it, the way this works is it's not preventive. You don't take it as a prophylactic, but in fact, if you think you have some symptoms, then you start taking it. Is that right? How quickly do you have to take it after you start developing the symptoms?
Well, we have made a lot of improvements in treatment already, but most of those treatments have to be given in a hospital. They're administered, such as, they're medications that are intravenous. This is an oral pill which you take, so it can be taken before you're hospitalized when COVID symptoms are severe and you might need to go to the hospital soon. So that can be, a huge help in helping to reduce our hospitals from being overwhelmed. Again, this does not prevent COVID. It is we still need to really work on getting our vaccination rates up. But for those who are vaccinated and have severe breakthrough infections, and especially for those who are unvaccinated and have severe COVID infections, this treatment can really help to reduce death.
Are there potential ramifications for the rest of the world as well? Particularly, we have had some problems delivering, for example, the vaccines, particularly in cold storage situations. This would be a pill presumably doesn't need any special treatment.
Absolutely. That's one of the most exciting parts of this treatment. It is an easy oral medication that doesn't need cold storage. So globally, this, can be a huge assistance. We have many countries, again, that haven't had great access to the vaccine. We know it's going to be another 6 or 12 months before we can really get high vaccine uptake globally the way we need to be. And there's also many hospital systems that are overwhelmed globally. So having a medication like this that can be given orally outside of a hospital setting and can reduce dramatically hospitalization is going to be a really good help globally.
Doctor, the other big news of the week is about children's vaccines for COVID. And now we're starting to distribute them. People are starting to get the shots in the arms. At the same time, we hear some reports of resistance. We've had resistance to adult vaccinations, but perhaps even more so for children. I've heard anecdotally some parents say, it's fine for me, I'm not sure of my kids. What do we know about vaccinations for children?
Well, this is some long-awaited good news. There are a lot of parents that have really been waiting to be able to get their children vaccinated and protected. So there was very rigorous study of this vaccine in children. There was work to optimize the dose to get maximal benefit with minimal side effects. It's been shown to be very safe and effective and is now for the first time available to children between ages 6 and 11. So I think it's a really exciting development that can help reduce transmission and protect kids. Absolutely. There are, people who want to continue to get more information, but this is a well-studied vaccine. We waited to collect really good data in kids and we have it. So I think it's an exciting development.
One last one here. Where are we overall in the fight against COVID? My sense is that the cases are coming down again in the United States, although I just read today in Europe and Central Asia that may be having another wave developing.
Yeah, we're in the U.S. rates had been going down, but these past few days, they've begun to turn back up. And I think we may be beginning to see the next wave coming in the U.S., although we'll have to wait and see. I'm certain another wave is coming this winter. And the question is whether we're already beginning. Europe has been seeing increasing rates for more than a month now, and they're in the middle of a really serious wave of infection throughout Europe. So I think that the U.S. sadly is headed that way as well, because we do not yet have enough protection. And we're hopefully going to see a lot less deaths this winter than last winter because we have had success with vaccination. But rates are turning around in the U.S.
Yeah, sadly, what happens when we all go back inside. Thank you so much, Doctor. That's Dr. Amber D'Souza of Johns Hopkins University. Coming up, former Treasury Secretary Larry Summers on the Fed's need to step on the brake before it hits the traffic jam of inflation. This is Balance of Power on Bloomberg Television and Radio.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's $2 billion buyback is an important step, I think, and it shows confidence that we have in the underlying performance of the business and outlook, and shows a commitment to try and normalize our capital base.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
About to vote on the infrastructure and Build Back Better packages, something former Treasury Secretary Larry Summers favors, but he also wants to make sure we all read the fine print.
Look, I hope we get this done. I hope both bills pass, the bipartisan infrastructure bill and some version of the so-called reconciliation bill. There's sure a lot of effort going into building better, build back better, and I hope it works out. I also hope people are going to keep a very, very close eye on this, since at the very last stage, that's when abusive provisions or misprovisions are sometimes put in. I'm glad to see that the provisions on SALT deductions look like they're being modified somewhat. It would have been a real tragedy, David, I think, if the provisions had ended up being written in a way where people in the top 0.1% of the income distribution got a substantial tax cut. I think we're moving towards fixing that. But look, these are investments that our country should be making. It's also not too early to say that it's not the amount of money you spend and the nobility of the cause you spend it on, but it's how well you spend the money that matters. You know, is money for childcare and pre-K going to help kids, or is it going to help the providers of childcare services? Are infrastructure projects going to produce a better infrastructure, or are they just going to help the businesses that provide infrastructure services? It's going to be really important, both in terms of the effectiveness of the investments and in terms of the American people's confidence in government, that this money be spent well as being spent on a significant scale.
That was part of my interview with former Treasury Secretary Larry Summers. You can hear more on Wall Street Week. That airs tonight at 6 p.m. Eastern Time. Check out the Balance of Power newsletter on the terminal and online. And coming up, Balance of Power will continue on Bloomberg Radio. In our second hour, we'll get specific scoring on the costs and revenues in that Build Back Better package from the Penn-Wharton budget model. This is Balance of Power, and we are on Bloomberg Television and on radio.
How much stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know.
From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, payrolls deliver an upside surprise, Chairman Powell sticking to script, and Governor Bailey shaking things up. We begin with the big issue, a solid jobs report.
531,000 jobs added in October.
Pretty impressive number. The job market continuing to heal.
A strong report overall with one qualification.
The labor force participation rate.
Labor force participation. It's not moving up.
I heard somebody earlier say, there's a lot of uncertainty.
People are focusing on the demand side.
I'm just not sure that's right.
We have a supply side problem, not a demand side problem.
It's just how fast can you bring people back in?
The question is, how long will that take?
The Fed will be patient.
The Fed will wait. They will argue that they need more data.
They're waiting on that full employment debate.
Joining us now to discuss Bank of America's Matt Dizok, Charles Schwab's Kathy Jones, and George Bory of Wells Fargo. Let's get the individual reaction to the payrolls report first and work from there. Kathy, first to you.
Yeah, I think it was a good report. Very solid. Big upward revisions to the previous couple of months, which, is consistent with an expanding job market. You tend to get those big revisions when you have a growing job profile. So even the labor force participation, some of the key components like women ticked up a little bit. So all in all, I thought it was a very solid report. We're really seeing people get back to the job market, and we're on our way probably by next, summer, next fall, to hitting those pre-pandemic levels.
George Bory, your take.
Yeah, it was a very strong report. I mean, it underscored the health of the economy. The labor market is clearly doing well, and we're still very much in recovery mode. Many people have pointed towards the participation rate as being a particular weak spot. That's certainly true, but from a jobs perspective, for those that want a job, there are jobs to be had, and it's very clear that companies and hirers kind of across the board are looking to add jobs.
Matt Dizok, what about you, sir?
Yeah, so I agree with both panelists. A strong report, but also a very unsurprising report. We expected it to be strong. There's been a difference between the establishment survey and the household survey over the last couple of months. The payrolls numbers were coming in a little bit weak from the establishment survey, and that disconnect was going to be resolved. We're not surprised it was resolved with a stronger employment report across the board, with both payrolls improving and the net revision. So it's not a surprise. The labor market is very strong right now. And if we continue to add jobs at this pace, we will be back to pre-COVID employment 28 months from the peak. And we look back at the last 4 recessions back to 1980, that would be the quickest time back to full employment, the peak number of jobs you had before the recession, back to the recession in 1980.
Wow. So this is going to happen really quickly. And I just wonder in the meantime how the chairman of the Federal Reserve responds to that. Earlier in the week, he preached patience, and I think the market bought that. Kathy, when you look at how the market has responded to this data, push it through the bond market, yields are in on 10s by 7 basis points, back to 146. On 2s, we're down by 3. This is what Goldman had to say on the move in the bond market, Kathy. I'd love your response to it. The report itself sets a firmer foundation for higher yields, but there's a broader environment of markets rethinking how aggressive central banks may get with regard to inflation, given the outcome of the Bank of England meeting yesterday. Kathy, your response to that, please.
Well, I would think if you were worried that central banks were going to fall behind the curve on inflation, which I think was a concern when we got the mixed information from the Bank of England, that you would see the curve steepen, not flatten. So I think what's happening here is, A, positioning was off going into this, and B, the market's saying, yeah, you know, it's sort of a vote of confidence in the Fed. Yeah, we're going to see short-term rates move up, but we're not going to see inflation get out of control. You know, now, having said that, I think that yields are too low across the curve relative to the pace of economic growth that we're expecting in 2022. But I think the market reaction is not indicating some sort of concern that central banks are going too slowly or will go too slowly and let inflation really bubble up.
George, is that mission accomplished for this Federal Reserve, to see less of a reaction in the market off the back of a pretty solid payrolls report?
Yeah, Jonathan, I think you can make a very strong statement that, you know, what Powell's done is he's avoided a taper tantrum. You know, he's been able to launch a tapering program without rattling the market. That is a huge sign of success. And his commentary yesterday, combined with what he said at the last meeting, you know, really sort of highlighted his ability to kind of finesse the markets, to get things moving as it relates to pulling with liquidity out of the system and really kind of getting kind of the tapering program up and running. And he's learned the lessons and really executed. And you contrast that with what happened in the UK earlier this week, where you had more of a botched message, and you get two very diverging stories. But the underlying premise, I think, which is where we get these very powerful moves. You know, as Kathy mentioned, bond yields are low relative to where fundamentals are. The technicals in the fixed income market are still very, very strong. The demand for duration is very high. The need for yield is still very high, and quantitative easing is still in place. This is tapering that's going to come. And so we haven't fully fleshed that out yet. And so you get these extreme moves like you saw over the last couple of days as the market just simply recalibrates it. Bottom line, Fed threaded the needle. They've avoided the taper a taper tantrum, but they really are trying to recalibrate kind of the bond market in a slow and steady pace. And I think this is just one more step on that road.
And George, in many ways, so far, so good. It's intriguing to me that the biggest move we've seen on the front end this week wasn't after the Fed meeting. It was after the Bank of England's meeting, when yields came in on 2s in the US by 4 and in the UK by more than 20 basis points. The reduction of QE, we've hardly talked about it for days. I haven't as a journalist. My guests have hardly brought it up. Maybe that's mission accomplished as well. I actually asked this question of Bob Michael going into the decision of JP Morgan Asset Management. How would the market react? Would it be offset by what happens with the taper story out of the Treasury? Take a listen to what Bob had to say.
the Fed and other central banks are in buying. And then when you get down to about 120, you lose the will to be long because real yields are too negative, and you start to set the shorts again, and then you're only left with Fed buying. So I think it's the large-scale asset purchases that are the relentless dynamic in the bond market. You're going to miss that $120 billion in additional purchases.
Matt Dizok, I want your response to that last line. You are going to miss that $120 billion in additional purchases. Are you?
Over time, that's right. Over time, we agree that the path of rate hikes is going to be higher. But the point of this Fed meeting was not really maximum employment. It wasn't really inflation. As George had said, the Fed had one sort of micro short-term goal here and still has that. Avoid a taper tantrum. That's been their framework and their mindset going into these meetings. And that makes it pretty easy to figure out the meetings. It's my job's good right now. It's Fed's never been more important. It's never been easier to call. They telegraph everything. This will make my job easy. I appreciate it. So it was an unsurprising meeting, but over time, yes, removing the taper will have an effect on higher yields, certainly assuming that inflation stays at an above trend rate, which we think will happen. We think there's a definite misdiagnosis going on here. This is not just COVID, Delta, supply chain issues. There's more going on here. There's too much aggregate demand. People are relying too much on the COVID excuse for supply chain disruptions, not enough on the bullwhip effect, not enough on aggregate demand causing too much supply shortages. So as long as inflation continues, yes, they pull back taper, rates should move higher.
Kathy, your response, please.
Yeah, I think that as I said, I think that real rates are low relative to where our expectations are for the economy, and that they will tend to move higher. We're not as concerned about the taper process or even about inflation. We think it'll stay high and sticky for a while, but I think by the second half of next year, we'll certainly see some deceleration. We're already starting to see that on some of the goods side, and we'll probably start to see that on the service sector as well once things balance out. This has been a really tough period of time in order to try to forecast anything. Is it a recession even, or was it just a significant shutdown and reopening? But that being said, I think that the path of least resistance will be higher in yields, and particularly in real yields, as both, some of the inflation expectations may be built in at the short end are a little high, but as nominals have to rise over time to meet where the economy is going to be.
George Bory, I just want a final word from you on this. As we look forward, and increasingly in the next few weeks, I'll get a ton of emails in my inbox, you guys will too, of outlooks for next year. And as we think about next year, I want to think about where we've been. This was another month, looking back, where the spread on Wall Street for payrolls was anywhere from 250K all the way up to 700. We'll often forget that the days after the number. The number's great, 531, okay, move on. But George, it seems to me that we're still struggling to get a decent read on this economy, that the range of outcomes for the previous month, never mind next year, is wide, wide, wide. Just a final comment from you, George, on that.
Yeah, the expectation for 2022 is we're still in a pretty healthy economy, as Kathy said. It's pretty robust. Job growth should remain pretty persistent as we head into 2022. But the sort of ongoing deceleration will be the big theme. I think in the bond market, sort of a long drawn out flattener. We think it'll be a bear flattener, so higher yields, flatter curves, is what the script is sort of laid out to be. Excluding a meaningful exogenous shock, that's where we're headed. The deceleration coming off of all the stimulus, all the proactive activity from policymakers over the last couple of, the last year or so, start to fade, and you start to get closer to, what you'd consider more of a natural rate of growth and a natural rate of unemployment. Market's still trying to figure out where that's going to be, but that's directionally where we think we're headed.
George Bory from Allspring Global Investments. George, forgive me, I'm so used to saying Wells all the time. I'm going to move on, don't worry. Yeah, Kathy Jones of Schwab and Matt Dizok of Bank of America sticking with us. Coming up on the programme, up next, the auction block. Borrowers racing to get ahead of the Fed and the payrolls report. That's next. This is Bloomberg.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating. I am no Sinophobe, very far from it.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now.
Wrap it
into
up.
weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here. Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe, with corporates accounting for 70% of weekly sales, volumes falling to 20 billion euros in the slowest week since August. US high-grade debt sales getting off to a fast start, pricing 16 billion in just 2 days, with JP Morgan and American Express leading the charge, and a more muted week in high yield, pricing a little over 5 billion, with Teva Pharmaceuticals headlining the action. A little bit earlier on this morning, PGIM's Michael Collins weighed in on the market action and the reaction to the Fed decision. This was the quote from him. Overall, markets seem to have drawn a pro-growth conclusion from the press conference, perhaps to some degree stemming from the chair's comments that rate hikes would only be considered after full employment had been achieved. I caught up with him, and this is what he had to say.
The jobs number and the chairman's comments aren't the half of it. I think this news actually from Pfizer and on the COVID side are a game changer, right? I mean, this is a real positive for the supply side of the economy and the demand side.
With us now, Matt Diesel, Kathy Jones, George Borey. George, I want to start there. Just how pro-growth this week has been, and pro-risk more specifically in risk assets. We had a really hot ISM, seems to have been forgotten. We have a chairman who's pledging and preaching patience, and we have a job report that looks really good, but not good enough to bring the Fed back in. How good is that for this credit market, for risk assets more broadly, George?
Well, just look at the equity market. You know, over the last couple of days, equity markets continue to make new highs. Looks like the S&P is breaking to the upside. But if you look within fixed income, we've had a moderation in yields. Bond prices have gone up. And so, you know, there is sort of a kind of a Goldilocks kind of rally happening kind of across the board. Gold is up, oil's up, bonds are up, stocks are up, credit spreads are a little bit tighter. And it all comes down to the fact that sort of the worst fears of central banks, developed market central banks, over tightening too quickly, that has started to abate. And so it's kind of put a new lease of life, if you will, into the run up in asset prices, because the expectation for yields are moderated, and the data looks good. You know, as we talked about before, the job market looks pretty healthy. The economic backdrop looks pretty solid. Corporate earnings continue to come in. And so there's good reasons to be pretty optimistic. You know, the only weak spot that we would say is you got to watch liquidity and you need to watch volatility. Measures of vol in the world of fixed income starting to tick up. Now, coming off of low levels, but you are starting to see some evidence that sort of anticipation of less liquidity is starting to work its way into the market. It's not, you know, sort of manifesting itself in any meaningful sell-off or shift in kind of risk appetite, but on the margin, you are starting to see some degree of kind of volatility, you know, start to notch a little bit higher, and that's something that we're watching.
Let's build on that. I have to say, from my perspective, Kathy, I was surprised that the move higher we've seen in rates up until recently at the front end of the curve didn't bleed into risk more broadly. Did that surprise you, and what have you learned from that?
Yeah, I would have thought we might have seen a little bit more vol. We've seen a little bit of a tick up there and a tiny amount of spread widening happening in the high yield market. But overall, I would agree that the outlook for credit's just really good. I mean, corporate earnings, corporations flush with cash, risk appetite is very, very strong still from the investor side. Everything's great in credit except for the yield. The yield and the spread very low. And that sets you up for, some surprises down the road. But at this stage of the game, it's too early, I think, to pull back. You just have to pick your spots a bit more carefully.
Matt Diesel, this conversation's going so well. It's so positive. It might make people nervous. Does it make you nervous?
No, I thought that was a funny comment. I like that. I agree with it. Everything's good except the yield. Except for that, how is the play, Mrs. Lincoln? So it's, sure. The yields aren't that great. But to your question on risk assets, it is a good environment for risk assets. And we want to be careful here. We need to caveat that there's always short-term volatility. We're not making a short-term call here. But for risk assets, we're in a very good place. And moderate inflation, 2, 3, 4, even 5% inflation is fine for equities. We look back historically to 1920. There is very little difference, if any, between nominal and real returns in the 0 to 2% inflation environment or 2 to 4% inflation environment. And it makes sense. There are really two big factors that are going to drive corporate earnings here. First, there is, as we said before, additional aggregate demand. The inflation we're seeing here is a gap between real and nominal growth, with inflation filling that gap. There is excess demand now. That's great for corporations selling goods and services. But to get higher revenues, you don't just need to sell more goods and services. You can just increase the prices of those goods and services. So inflation, even without selling more goods and services, will lead to higher nominal revenues with good operating leverage that will lead to higher earnings. So you've got a double kicker here. You've got aggregate demand and higher prices. They have pricing power, selling more at higher prices. This is good for corporate revenues. This is good for earnings. As usual, the stock market anticipated this, right? The big change this year in equities is not the valuation component. It's been the earnings component. So as usual, the stock market sniffed this out early. Faster than us, faster than forecasters, faster than anyone else, the stock market sniffed out the strong
Matt Diesel, what I hear from you right now
earnings environment
is that the credit market and your world is lagging what the equity guys are doing. Is that what you just said?
Yeah, as usual, they're having a lot more fun than we are, but that's no surprise. Been doing this for over 25 years, and that's pretty much day in, day out. They have a better time than I do.
Just in terms of the credit cycle, it used to be that credit leads equity. What are we learning on that side of things right now, George? And I know you want to have a word about defaults too.
Yeah, I mean, I think what we're seeing out of the credit markets, defaults are almost, pretty much at zero. They certainly are at zero over the last few months. There's been virtually no corporate defaults. A few scares, but nothing material. And so the trend, and so that's sort of where sort of equities takes over and becomes the more dominant force in the market, because what credit is telling you right now is we're pretty sanguine. Not a big risk of default. The chances of you getting your money back on time is very high. Credit spreads are tight, but they're not tightening anymore. We're sort of kind of bobbing along at the bottom here, and that's one of our kind of key assumptions as we go into next year. A carry trade, which is always a dangerous trade, but a carry trade seems to be the most likely scenario. That can last for a while, but that's sort of the way we're kind of thinking about the market and looking for any signs that are defaults picking up. No, not yet. Should credit spreads widen? Well, if vol goes up, credit spreads should go up. There's a little bit of noise there, but not a lot to get worried about just yet.
They are in one place, China, and it just doesn't feature in the conversation at the moment in the way that maybe it should. Kathy Jones, George Bory, Matt Diesel sticking with us. Still ahead, the final spread, the week ahead, featuring Chairman Powell and another busy stretch of Fed speak. That conversation just around the corner. From New York, this is Bloomberg.
City.
Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Engine number one was able to do on the Exxon fight. It opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, a busy slate of Fed speak, including Chairman Powell, plus Harker, Evans, Bullard and Daly, all on the calendar. US CPI on Wednesday, followed by jobless claims, and the US bond market will be closed for Veterans Day on Thursday. And finally, the University of Michigan Consumer Sentiment Survey out on Friday. Kathy, just quickly, are we done with the Fed speak? Anything you need to hear next week?
Well, I think they'll try to reinforce the message that Powell sent. But, recently we've had a lot of dispersion of opinions on the part of the various Fed speakers. And we also have the renomination, or maybe not renomination, of Powell coming up. So when it comes to the Fed, I think that's really where the focus is going to be. How much agreement is there with Powell right now? And is Powell going to be around in a couple of months?
And reportedly, Chairman Powell and Governor Brainerd were at the White House yesterday. Axios reporting in the last 24 hours that the White House is encouraging senators to go and meet with Chairman Powell before Thanksgiving. So maybe we're close. And let's start there in the rapid fire round. 3 quick questions, 3 quick answers. Does Chairman Powell get a second term? Yes or no? Just yes or no, Kathy?
Yes.
George?
Yes.
Matt?
Yes, he does.
OK. The tapering started at the Federal Reserve. Is tapering tightening? Is tapering tightening? Yes or no? George?
Yes.
Kathy?
No.
Matt?
Yes, just don't tell the Fed.
And can we wrap things up with the Bank of England and the communication mess of the last month? Let's finish there. Whose fault was it? The messenger or the market? The messenger or the market? Kathy?
Messenger.
Matt?
With apologies, the messenger.
George?
100% the messenger.
Governor Bailey will not be taking your calls. Matt Diesel, Kathy Jones, George Bory, I'm with you, I agree. From New York City, it's great to catch up with all of you. Same time, same place next Friday, 1 p.m. New York time. For our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg TV.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
I'm Rishka Gupta. Let's get to the first word news this afternoon. President Biden is considering a potential release from the Strategic Petroleum Reserve to bring down those gasoline prices after OPEC Plus rejected his request to increase crude production faster. That's according to Energy Secretary Jennifer Granholm, who told Bloomberg TV today the Biden administration is, quote, very concerned about the prices at the pump.
On average, gasoline prices will be about $3.05 at the beginning of December. They will do an adjustment to that forecast in the next week or so we'll see if that holds. Mm-hmm. But clearly, the Biden administration is very concerned about the price at the pump and certainly the price in people's wallets for natural gas as well for this winter, including, I would say, propane and heating oil, particularly in the Northeast.
OPEC and its allies ignored the pleas of its customers and stuck to its plan for gradual monthly oil output increases of 400,000 barrels a day. Major consumers say that's not enough to sustain the post-COVID economic recovery. And it's been compared to a Shakespearean drama and a soap opera, but this real family drama has billions of dollars at stake. The Supreme Court of British Columbia is expected to rule in a matter of hours on the messy family boardroom battle over control of Rogers Communications, Canada's largest wireless firm. At issue is whether Edward Rogers, son of the firm's late founder Ted Rogers, can replace several of the board's directors with his own picks without shareholder approval. Other board members, including his mother and sisters, are trying to stop him. And a company owned by the Chinese government is working on an offer to acquire Hong Kong's influential South China Morning Post, the city's most prominent English-language newspaper. Bloomberg has learned Bohemia Culture is interested in a deal with Alibaba. Bloomberg News reported back in March that Alibaba has come under pressure from the Chinese government to divest some of its media assets, including Cmpro. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Hi, I'm Amanda Lang. Welcome to Bloomberg Markets.
And I'm Matt Miller. We welcome both our Bloomberg and our BNN Bloomberg audiences each day at this hour. Here are the top stories we're following for you from around the world. Stocks are at a record high as jobs growth ignites a rally in America. The labor market seems in a recovery, and both really the U.S. and Canada. Will break down all the numbers with Diane Swank, chief economist at Grant Thornton. Plus, the economy likely to get a boost from Pfizer. Really globally, those shares are soaring after its COVID pill shows strong results in clinical trials. We'll discuss the possible game-changing effect of this treatment. And as the economy reopens, maybe faster with the Pfizer pill, electric scooter and bike startup Lime is looking to expand its fleet. It raises more than $500 million with some notable investors, including Uber and Abu Dhabi. We'll speak to the CEO, Wayne Ting. Amanda?
And Matt, some of those factors you've mentioned are at play in the markets today. Certainly the jobs data sending stocks tracking to yet another weekly high. And you can see that the 10-year is down below 1.5. So the growth story is very much in the driver's seat today. And on the internals, you're seeing some of the high growth stocks that are also leading these markets. In fact, for the S&P 500, every subgroup is in positive territory with the exception of healthcare. And it is really that news about Pfizer's pill for COVID-19 that has the whole group moving. Pfizer to the upside, others weakening. Merck is suffering, but Moderna, wow, a 24% move lower for Moderna. This seen as just another blow to that company, already sort of taking some hits on the vaccine front relative to Pfizer as well. We are watching energy also strong on the day today, but across the board, there's a lot of enthusiasm, and some of that is, as you said, being driven by the jobs numbers we saw. Both the U.S. and Canada out with reports today, and of course, the news is good, perhaps slightly less so on the Canadian front, adding 31,000 jobs in this country. But the unemployment rate here falling to 6.7%. Total hours worked rising 1%. We'll admit, though, most of the attention today when it comes to investments are on the U.S. data and just what it says about the strengths of the recovery. Here's what former Treasury Secretary Larry Summers had to say about it.
We've got a very, very strong economy on the demand side and not a very strong economy on the supply side. And that's risking an overheating. You saw a lot of job creation. You didn't see an increase in labor force participation.
All right, well, let's bring in Diane Swank, Grant Thornton's chief economist. And Diane, there's been a lot of talk about the fact that this is a supply side inflationary story, not a demand side. But let's step back and look at the jobs. We're not back to pre-pandemic levels. In other words, if you took the growth, the trajectory of job growth, we're not there yet. How would you rate the health of the recovery at this point?
Actually, we just got a big step up, and I'm really encouraged to see the private sector picking up where the public sector has left off. We saw education jobs continue to fall. That's really hard, especially for people looking for the extracurricular programs, the extra after-school programs that help their kids to stay in school longer so they can actually work. And childcare continued to decline. That said, and that's one of the participation issues out there, the friction there, women did come back a bit after losing ground in September, but we're still low. I think it's really important, though, to point out that we are starting to see some real traction, and as we open up the economy more, you're going to see some very robust job gains through the end of the year, and I think we're going to see the Federal Reserve, in response to that, accelerate their tapering of asset purchases once we get into 2022. They left the door wide open for that earlier this week with another strong November number. I think that's exactly what they're going to see because they want to space out the time from the end of tapering their asset purchases and an actual liftoff in rates.
Now, Diane, President Biden was talking about, I think 190 some people are fully vaccinated in the U.S. Now, that's got to be the biggest piece of the traction this economic recovery has got. Now we have news from Pfizer that they may have a pill. They say it reduces hospitalization and death in high-risk cases 89%. That's astounding. What kind of game changer could that be for the economic recovery?
It's huge, along with other treatments we already have. We've reduced hospitalizations already. And most importantly, we're going to be vaccinating kids now, 5 to 11 years old. That really is important as well in terms of keeping kids in school and not having these quarantines that we were having. All of that allows us to open the economy more fully. Now, it allows the U.S. to open the economy more fully in a global economy where a pandemic is still ongoing. And I think think that's something that gets lost in translation. But what I do see out there is that we are going to see some very robust job gains going forward. This is just the beginning of the economy reaccelerating after the Delta wave. And to the extent that we can keep outbreaks, particularly in the U.S., muted, you're going to see the overall economy pick up. And, it's sort of all of the above. What's causing inflation today? Everything from a demand surge to supply chain bottlenecks to also a surge in demand for labor with frictions in the labor market of people returning. That demand in labor, Indeed has done some work on this. Nick Bunker over at Indeed has done estimates, and they're really good at it. By the end of October, they think we have a record-breaking 11.1 million job openings that the JOLTS data will show. That is stunning after already record numbers in August. So we really are outpacing job openings versus labor supply as well.
I want to ask about the infrastructure spending planned and the Build Back Better spending. If the vaccines and the medicines are one huge piece of the reopening, the economic recovery, the growth that we've seen, how much more of a boost can we get from 500 billion or 1.75 trillion in spending? Are those bills really important, really necessary for growth?
It's not about growth, but those bills are certainly the infrastructure bill and, sorry, my dog is in the background there. Sorry, the infrastructure bill is really important, and also part of the Build Back Better includes climate change issues as well, which I wish was in the infrastructure bill. To me, we should finance that at really low rates at longer term bonds, because the world is paying us to do it on an inflation-adjusted basis, and there's huge productivity gains and aversion of losses due to climate change by embracing that. So that's important, and they take time to ramp up. That stuff's not going to hit till 2024, 2025. On the other side of it, we should pay for social spending that's also necessary, but you got to pay for it. Otherwise, that can be more inflationary in an environment where we already have inflation running hot. And I do think you have to remember, outside of Chairman Powell, most of the Fed is hardwired to worry more about inflation, along with other central banks, than the labor market.
And that gets us back to, Larry Summers at the beginning, in disagreement with some other pretty serious economists, sounds like perhaps including Diane Swonk. Should the Fed be acting more aggressively now to tackle inflation rather than waiting for it to take hold?
Well, I actually do think the inflation will be transitory, but transitory by 2023, late 2023, 2024 is too long for the public and anyone else out there. And the Fed, I think, will get very nervous because we're going to get hotter inflation before it cools, and we're going to have some wage gains. I don't think it's going to become entrenched like we saw in the 1970s. That said, the Fed, I think the biggest risk is that because of that way the Fed is hardwired, regardless of how Chairman Powell feels, is that we're going to see more aggressive rate hikes, pulling up, accelerating tapering, and more aggressive rate hikes in 2022 and 2023, which could give us more of a boom-bust cycle. Much of those supply chain problems, people are double ordering too. That will give us unwanted surge in inventories as demand cools in 2023.
Diane, thanks so much for joining us. Great to get your take on this. Always love having your insight. Diane Swonk there is the chief economist over at Grant Thornton. And coming up, shares of Pfizer. We were talking about this surge after the drug maker reports its new COVID therapy pill cuts hospitalizations and deaths by close to 90%. This isn't just in any healthy person. This is the high-risk cases. So it's really huge if this proves to be truly effective. We'll discuss how the breakthrough could alter the economic recovery for the good. When we come back, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Gasoline prices are high because it's mixed with ethanol that went tenfold. Gasoline prices are high because there is low stocks in the U.S.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Markets. I'm Matt Miller with Amanda Lang. Now, the race to develop a pill that treats COVID looks to have taken a huge leap forward today. Pfizer announcing that its treatment reduced hospitalizations and deaths in high-risk patients by 89% in recent trials. That news sending Pfizer shares obviously soaring higher. The drug maker says it will submit its findings to U.S. regulatory authorities for emergency authorization as soon as possible. And the president of the United States already talked about it in his speech today. So, you know, I think everyone is talking about this story. It's the most read on the Bloomberg terminal. There you can see Pfizer shares are doing really well. And of course, Pfizer shares have already done really well. This could really change the course of the economic recovery, Amanda.
It really could. And then when it comes to Pfizer, it's interesting to consider what it says about the company. Morningstar today saying they're not changing their fair value estimates for Pfizer because the long tail on this drug probably isn't there. COVID will go away, we all hope. But what it says about Pfizer's ability to bring a drug like this to market is very meaningful. And that might be, Matt, why we're seeing companies like Moderna suffering so badly today, 24% decline for Moderna. This really speaks to Pfizer's ability to turn its pipeline into reality.
Yeah. So my one interesting take on this, though, is that it does give anti-vaxxers a little bit more traction, especially people who are against vaccine mandates, because why would you mandate a vaccine if there's a treatment that cures you from the disease anyway as soon as you get it? Joining us to talk more about it is Bloomberg health reporter Robert Langreth. So, Robert, what do we know about this? We've seen what clinical trials. I think they've stopped because they were so successful. Does that mean we should believe this thing really works?
Well, this is what we have right now is basically a press release, a statement from the company. There's no published scientific study, and so we don't really know the details yet. Just the kind of the top line data the top line data, for the vaccine, Pfizer has been pretty reliable, and that data is held up with their vaccine as it's been reviewed by the FDA in the past. So we have Pfizer's word for it, and that's proven pretty reliable in the pandemic before. But this is Pfizer's first big study of its new drug in high-risk patients. We're talking unvaccinated, older patients typically, and this dramatically reduced the hospitalization and death rate in this group of patients. In this trial, no patient that got the drug died, whereas approximately 10 people who got the placebo group died. It's a 5-day treatment, and you need to start it within about 5 days of getting symptoms. So they're going to rush this to the FDA as soon as possible. And the reason people are so excited about this is this has been a long-time goal of public health authorities, the idea that you could have a pill that you could take at the first sign of symptoms that might, prevent the worst complications, and you could take it at home, maybe much easier to get and prescribe for anyone. That's been an important goal, and this, if it holds up, is a really important steps towards having that type of treatment.
And I mean, obviously, great news, as Matt says. This is an important step if it does hold up for global economies, not just for Pfizer. Just give a nod to the big declines we're seeing in some of its rivals. Merck, of course, has a rival pill already approved, so you can see why there might be some sell-off there. Moderna down 24%, 21% now. Why that kind of reaction here?
Well, I don't know the fine details on all the vaccine stocks, but they're definitely down. And one idea, is that the availability of a pill could reduce some of the demand for a vaccine over the long term. Certainly, you could see, it'd be one less reason for a vaccine hesitant person to get it. But the other thing that's going on is Pfizer has other trials going on, and one of the other trials is a trial in standard risk people, and that trial includes people that are vaccinated. Like, it doesn't prevent symptoms from worsening from breakthrough cases as well. So you could imagine a situation of that second trial works that, maybe people wouldn't rush in to get boosters quite as much if they felt, hey, I could get a pill. If I get any symptoms, I'm going to postpone getting that booster. So that's kind of the general reason. The general thought is that, might over time reduce the vaccine market, essentially.
Robert, thanks so much for joining us. Bloomberg's Robert Langworth coming on with this breaking story. We'll continue, obviously, to report out more news on this. And we're going to have an interview with the CEO of Pfizer. Albert Bourla joins us at 2 p.m. New York time to talk about it. So just about 10 minutes from now. Coming up, stepping into the limelight. As clean alternatives to cars are on the rise, we'll speak to the CEO, Wayne Ting, next. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the...
Coming in and saying, look, this is a new definition.
We talked about this, we talked of other things. Now that's moving to become mandatory.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Electric scooter and bike startup Lime announced today that it has raised more than $500 million in debt. That is ahead of a planned public offering next year. It's backed by the likes of Uber and Abu Dhabi. Joining us now is Lime CEO Wayne Ting. Wayne, great to have you with us. And let's just start with the market that you're building here. Where are you in terms of your progress to full kind of consumer availability?
Yeah, we're super excited to announce we raised $500 million today to continue building a transportation platform that is shared, that is affordable and carbon free. We're in over 200 cities around the world, 30 plus countries. Lime is the undisputed global leader in micromobility. Think it's about shared e-bikes and shared scooters. In fact, we're 2 times bigger than our nearest competitor in terms of active users. We're also significantly larger in terms of the number of cities we're in. And on top of that, last quarter we announced our second quarter of profitability, and we're on a path to continue transforming this business into a profitable, self-sustaining business over the long run.
Wayne, I normally live in Berlin. I work in Frankfurt a lot. If I'm running late or if I need to get across town and don't want to take a taxi, I will always jump on a scooter. It's really been a game changer for me. But I walk out the door in New York, I walk out the door in London looking for one, and I don't see them. What's going on there? Because these are pretty important cities.
Well, we're seeing more cities actually open themselves up and commit to micromobility. New York actually just announced a small pilot this year. London is scaling a pilot as we speak. But the reason why cities are committed to this, Matt, you mentioned it's oftentimes the fastest way to move. We see that in many cities, especially with congestions. It's more often than not one of the most affordable way. But the most important reason is that we are dramatically more green. The average trip on Lime produces less than 7% of the carbon emissions of an equivalent car trip. There is no greater crisis and challenge we face as a world than the climate crisis. The biggest source for carbon pollution in the United States is from transportation. The bulk of that is from personal cars and trucks.
I do want to bring up the actual pollution issue, though, Wayne, because they are also, they clutter the sidewalks, and they go from gorgeous green and white machines to something you don't necessarily want to look at very quickly. How do you deal with that kind of littering problem that we have?
Yeah, fantastic question. So we spend a lot of our time focusing on parking solutions, corrals. We also fine our users to make sure that they're parked in the right place. In some markets, we have lock-to solutions that help you lock to bike lanes. But I'll say, when people say, we're litter everywhere, I always ask, compared to what? Because if you go to any major city, walk down any street, I sometimes get a picture of an e-bike parked and somebody's complaining. Behind that e-bike is 10,000 cars down every street, every sidewalk. When we reduce the number of cars and bring more e-bikes and e-scooters, we will absolutely reduce cluttering. We will absolutely increase the efficiency of parking and make the cities more livable.
So as you look to an IPO, just give us a sense of your path to profitability or cash flow positivity. Where are you today? Where do you hope to be?
Well, so we announced our second quarter of EBITDA positive in Q3 of this year. We achieved the same thing a year ago. One of the key things that's allowed us to reach this is the introduction of our latest generation 4 e-bikes and e-scooters, which are more efficient, greater rider preference, and dramatically more green. We're going to take this capital and scale that generation 4, and that's going to help us continue to improve our profitability through next year.
And just really quickly here, Wayne, IPO or SPAC, or is it too soon to say what kind of route you'll take to the market?
I think we want to make sure we have the capital it takes to achieve our mission. Whether it's a SPAC or an IPO, we're going to take a look at the market and see what's the most optimal path. But we're going to keep an open mind as we look towards going public next year.
All right, Wayne Ting, thank you so much for that. That is Wayne Ting, the CEO of Lime. And Matt, I did want to take a minute to wish you a happy birthday. It is today. You're catching up to me, man. You're getting older. And one day, I don't know, will you ever be as old as